Good afternoon. My name is Kevin Cahill. I'm an assemblyman filling in for the chair of our Ways and Means Committee, Helene Weinstein, who has other obligations in the Capitol at this point. I am serving as one of the temporary co-chairs of this hearing, along with my good friend, Senator Liz Krueger, chairperson of the Finance Committee in the Senate. Today, we begin the 12th in a series of hearings conducted by the joint fiscal committees of the legislature regarding the governor's proposed budget for the fiscal year 2021-2022. The hearings are conducted pursuant to the New York State Constitution and legislative law. Today, the Assembly Ways and Means Committee and the Senate Finance Committee will hear testimony concerning the governor's budget proposal for taxes. I'll now introduce members of the Assembly who are present for this hearing, and then after that, Senator Krueger will introduce members of the Finance Committee and other committee members. For the Assembly, on the majority side, we have Assemblywoman Sandy Galiff, who chairs our Real Property Tax Committee, and Ways and Means Committee members Ed Braunstein and Harry Bronson. Senator, would you like to introduce your members?
Thank you very much, Kevin. I am joined today by my colleague, Senator John Liu, the chair of the Budget and Revenue Committee, Senator Brian Benjamin, Senator Julia Salazar, Senator Diane Savino, and our ranker for Ways, our ranker for Finance, Tom O'Mara. And Tom, I don't think you have other members here yet, right? Nope.
No, just me for now, but we're recirculating that new link, so that's probably slowing some people down. So
and if people join, we will make sure to announce them.
Sure.
No problem.
Thank you.
Okay. I'd like to turn it over to Assemblyman Ed Ra, the ranker on the Ways and Means Committee, so he can introduce his army of members who are present for the hearing.
Thank you, Mr. Temporary Co-Chair. Thank you for your leadership of this hearing. I want to just recognize Assemblyman Brian Miller, who is our ranking member on the Real Property Tax Committee, who is joining us.
Terrific. If there are any members who were not announced, please let us know. I see Assemblyman Chris Tague has shown up. Any other members present? Being none. Before I introduce the first witness, I'd like to remind all of the witnesses testifying today to keep your statements within the allotted time so that everyone can be afforded the opportunity to speak. This is especially important now that these hearings are being conducted virtually. All governmental entities will get 10 minutes to make oral presentations. So we'll start the proceedings today with a presentation from Commissioner Schmidt from the Department of Taxation and Finance. After the governmental witnesses, we'll proceed to hear testimony from the other witnesses, non-governmental witnesses who asked to testify here today. These witnesses will each have 3 minutes to make oral presentations to us. Witnesses are reminded that their testimony, which has been submitted in writing prior to the hearing, will be made part of the record of the hearing. Therefore, please don't read your testimony verbatim. Instead, experience has demonstrated that a concise summary of the highlights of the testimony will allow for more effective advocacy and will also allow for members' questions to be more focused and productive. All witnesses are also reminded that their remarks should be limited to the time remaining on the countdown clock in the Zoom window. Please find that clock right now and keep an eye on it. It's very important that testimony be within the prescribed time limits in order to afford all of the many witnesses seeking to join us today to testify so that they have an appropriate opportunity. We don't want to have to shut down anyone's Zoom screen if they exceed their time limit, but we will do so if necessary to keep the hearing moving and on track, given the large number of people seeking to testify. Likewise, members' questions will be limited by the countdown clock. Time limits for members of the legislature are as follows. The chairs of the committees relevant to this hearing will get 10 minutes each to ask questions and receive answers. The ranking members of these committees will get 5 minutes each, and all other members of the relevant committees will get 3 minutes each. There'll be no second rounds of questions for the members except for the relevant committee chairs. I want to emphasize that members should please note that these timeframes for questions include both questions and answers. So members are respectfully requested not to commence a new question with insufficient time on the clock within which the witness may answer. We thank everybody in advance for adhering to these important guidelines that are designed to ensure that all committee members have the opportunity to ask questions and to allow for a productive and informative hearing. Members should use the raise hand function to indicate that they would like to ask a question, and use the chat box if any procedural types questions are to be directed to either of the chairs. So with that, I will now call our first witness, the Honorable Commissioner Michael Reed Schmidt from the Department of Taxation and Finance. Welcome, Commissioner Schmidt.
Thank you, and good afternoon, Chair Kruger, temporary co-chair Cahill, and members of the fiscal committees. Thank you for inviting me today to testify on behalf of the Department of Taxation and Finance. I will briefly discuss the department's operations through the pandemic before making a few comments regarding Governor Cuomo's executive budget. I know a lot of commissioners are probably saying this year, but I truly could not be more proud of the performance of this department during what's been an extraordinarily challenging year. In spite of the pandemic, we fulfilled our core mission without significant disruption, and we took extraordinary steps to support the state's broader public health response, all while continuing to push forward our long-term agenda to help New York's taxpayers. So I'll start with our core processing and taxpayer services operations as a department. While the IRS halted operations for a large part of the year, at no point did we stop opening mail, processing returns, issuing refunds, or cashing checks. In 2020, we processed 26 million returns, collected $120 billion in revenue, and issued 10 million refunds without significant delay. We extended the personal income tax filing deadline from April to July. We abated interest and penalty for sales tax filers impacted by the pandemic, and we worked with our partners in the assessment community to address a range of property tax administration issues. And even as we fulfilled these core responsibilities, we assisted our sister agencies with theirs. As many of you know, the department runs the Consolidated Contact Center for New York State, which this year set a record by handling 5 million phone calls, including more than 2 million calls related to COVID, in partnership with the Department of Health. This has been a massive 24/7 interagency effort, and I want to recognize the hard work of the staff in the contact center across the department and indeed across the state for their tireless work on behalf of New Yorkers. Beyond our effort to maintain our revenue generating functions and support the public health response, we continue to push forward with key programmatic initiatives to improve the taxpayer experience. We are overhauling our correspondence program, which is producing significant improvements to the taxpayer experience as we speak. We continue to work on the replacement of legacy processing systems. We launched a marketing campaign to expand participation in our free file program, which produced a 57% increase in participation, generating more than 100,000 new free filers and saving New Yorkers more than $50 million in tax preparation fees. We undertook a public awareness campaign to encourage low-income New Yorkers to claim federal stimulus payments that weren't sent out automatically. The campaign helped reduce the number of unclaimed payments in New York by more than 200,000, bringing an additional $340 million into the state to help people meet basic needs during the pandemic. We enhanced the financial education resources we provide on our website, and in a special project that we believe to be the first of its kind for a tax agency in the nation, we are examining our operation through the lens of structural inequity, scrutinizing our policies, procedures, and systems to ensure that they are promoting a more equitable society. I know that the year ahead will be challenging, but I'm hopeful for continued progress at the department. So let me shift gears now and very briefly highlight different aspects of the executive budget that I believe merit careful consideration by the legislature. From addressing our fiscal and revenue issues to supporting our economic recovery to advancing programs that help working families, this budget is a strong first step in our state's efforts to build back better. Accordingly, the budget proposes to establish 3 new tax credits totaling $130 million to help small businesses, restaurants, and theatrical production companies to recover from the pandemic and bring jobs back to New York. Also, as access to the governor to affordable childcare remains a key priority, the budget provides meaningful new incentives for employers to help provide much needed childcare to employees. And finally, in an area that is very important to me and I know is very, very important for many of you, the area of consumer protection, the executive budget includes important provisions to enhance oversight of unscrupulous tax preparers, giving the department new and stronger tools to protect taxpayers from abuse in this area. So thank you again for inviting me to testify here today, and I'll be pleased to take your questions.
Assemblywoman Galiff, do you have questions?
I sure do. Yes.
Okay, please go ahead, 10 minutes.
Welcome, Commissioner. It's nicer to see you in one of the hearing rooms, but it is as it is. I'd like to just, you have a couple of new programs that are being recommended that affect real property. And one is the Enhanced STAR program. And as we all know, that seniors have always been able to get an exemption from their property tax. And now you're recommending a credit check. And I just wondered, why in the world are we doing this? What are the advantages to the state? What are the advantages to seniors? If you could explain that to me.
Absolutely. Thank you. Thank you for that question. Just a little bit of background, and to be clear, seniors who are currently enrolled in the Enhanced STAR program as an exemption would not be affected by this proposal. So this proposal wouldn't affect any existing Enhanced STAR exemptions. What it says is that when basic STAR beneficiaries become eligible for Enhanced STAR, usually because they age into it, right? They turn 65. Those new entrants into the Enhanced STAR program would be enrolled in Enhanced STAR and through the credit. And I think this is part of a longer trend in the department taking a more active role in administration of the STAR program. STAR overall is a $3 billion state program. Historically.
Can I stop you right there? I think what you're trying to do, every year we have something before us that changes the program. We also have mobile homes this year too. And so with the people, the public, it keeps changing. And we're going to have testimony from our assessors later, and for them to deal with all the changes. What is the value to the senior to have to wait to get a check as opposed to just not paying as much in the school tax? And I don't understand it.
Well, as you know, by law right now, the exemption program remains flat. The check program can increase by up to 2% every year. We're seeing that in 77% of school districts, those increases are happening, right? So that is a benefit.
Are you saying to the public that 77% of the public that are in Enhanced STAR in STAR that are getting a credit check are getting an increase from what they would have gotten if they didn't go into the program?
I'm saying in 77% of school districts, yes.
77, but that doesn't mean that the person is getting more money.
Well, it means that for every individual in those school districts, the credit recipients, the value of that credit is going up, whereas the value of the exemption is remaining flat for all those.
I'd like statistics on that if you can get that to me later, because what I've been hearing from constituents is they get into the program, it's like a switch and bait, and then they really aren't getting more money.
I'm happy to provide you with those statistics.
Okay. I just don't know I don't think you've explained the advantage to the senior having to go this direction. But can I ask you about late checks? Within the STAR program as it exists today, does everybody get their check before their property taxes are due? And I'm not talking about the day before they're due.
Yes, the vast majority of taxpayers are getting their checks before the property tax are due. This year it was 97% of taxpayers. I think there were challenges with some of the early implementation at the department of the program, some of that initial transition. I think right now, from my perspective, it's working very well, very effectively. And I think that's a testament to the good work of the team here.
Okay, we hope that continues. Let's go to mobile homes. The recommendation is to transfer the mobile home owners to get a credit check versus getting a deduction from their maintenance for their rent on their property. Why are we doing that? Is there a rationale behind that?
So this is a proposal that I think will almost certainly accrue to the benefit of many mobile homeowners. Right now, the STAR benefit goes as an exemption to the owner of the park, right? And then it flows through to those mobile homeowners. That owner is entitled to take a 2% fee from that. And in addition, there's a small but important technical difference between the credit program and the exemption program. But in the credit program, there's a $20,000 floor to valuation under the STAR program. So mobile homes that are below that $20,000 floor, they'll actually receive a greater benefit as a result of this. And I will say, from our perspective as a department, it allows us to provide that benefit directly to the mobile homeowner, to the person we want to make sure has the benefit, as opposed to relying on an intermediary.
Okay, that all sounds good, but how is the mobile homeowner going to know about this program? How are you going to advertise? Are you going to send something out to each one of them?
Yes. So with these programs, we generally we try to automatically enroll new enrollees in the program if there's a provision of law that enrolls them. I'd have to look at the details as to whether we have the data. I think as a result of some new data reporting we put in place this year, we'll be able to do that. But at a minimum, we'll be able to send letters directly to all those mobile homeowners to make sure that they get registered. I'd be very, very committed to making sure that we do that.
Right. Do you have any idea what the average STAR exemption is on mobile homes?
The average STAR exemption statewide is around $700. I'd have to get you a number specific to mobile homes. I'm not sure if we have that.
Okay, that's for residential homes, I guess. The 700. Okay. Could I ask about the renewable energy project portion of it?
Yep.
Because you're asking it to be extended from the development of renewable energy projects from 2025 to 2030. And as a part of the 30-day amendments, there is a recommendation to eliminate the use of income capitalization model when determining the assessed value for these energy projects. What standard assessment approach do you intend to establish?
So as you noted, this is a proposal which is mainly aimed at providing a consistency in administration and valuation methodologies with respect to renewable energy properties in New York State. That the methodology we would come up with is something that we would want to work with our partners in the assessment community, with local governments, to make sure that we come up with a methodology and take in stakeholder input and have a methodology that everyone feels comfortable with. So the purpose is to provide that certainty across the board for these projects across the state. The means is something that we want to work with stakeholders on.
Okay, so you're going to reach out to the local assessors on that one.
Absolutely.
Okay.
Now, I would just say, since you bring up the local assessors, I would be remiss if I didn't just say that they did a fantastic job this year. This was a tough year to be a local property tax assessor,
Right.
and we work closely with them to help address challenges. And I just want to say that I really appreciate their work.
Hopefully they're listening, because they're going to be on later on. So with the STAR exemption appeal process, going back to STAR a bit, you are recommending an independent review of the appeals or determinations. You're going to have the department do that instead. It would seem to me it's better to have somebody that is more independent doing this than you all. Can you tell me the rationale for why you're recommending that?
Well, our goal is to provide taxpayers with a faster answer to resolve issues more quickly. The Real Property Tax Board meets on a periodic basis throughout the year. So we have to, when we get protests and petitions in relating to the STAR program, we have to aggregate those. The taxpayer has to actually wait until we have a board meeting. We got to make sure we have a quorum at the board meeting, which isn't always the case. And then we have to review those. This, the process envisioned in the budget really aligns the process with a lot of administrative appeals you see throughout the state. We have processes within the agency, most notably with our Bureau of Conciliation and Mediation Services that deals with these types of taxpayer protests. And so I feel confident that we'll be able to make this transition in a way that is definitely to the benefit of taxpayers.
Okay, I'll try to come back with more questions. Sorry, it goes so fast. And I'm sorry to cut you off, but it just, I'm
No, I
looking
appreciate it.
time
It's
frame.
important to address all the issues. Thank you.
Thanks.
So we go to the Senate now.
Thank you. And our Chair of Budget and Revenue, Brian Benjamin.
Thank you so much, Chair Kruger, and thank you so much, Commissioner Schmidt, for being here. As the Chair of Budget and Revenue, Commissioner, I'm sure you're not going to be surprised that I want to start with the personal income tax surcharge that is first on the list here. First question for you is why start at the $5 million number? There are a number of people who believe that at least $1 million is probably a place that you should look at when you're talking about generating sort of the revenue that's needed to really help the state. Can you talk a little bit about why the surcharge starts at $5 million?
So the personal income tax surcharge in the executive budget is designed to address the budget challenges facing the state as a result of COVID. As you know, COVID had a dramatic impact on the state's fiscal circumstances. A 4-year revenue decline currently projected at $33 billion, less than what we had expected it to be. So, as a result of that, the executive put forward a set of proposals aimed at addressing that, absent what we all expect and hope, which is that $15 billion, that meaningful federal aid to help us fill that gap. With respect to the high income surcharge, a number of considerations have to go into the design of that. One is, of course, that the purpose of it is to raise revenue in light of the state's fiscal challenges. But of course, there are drawbacks too with respect to the impact on the state's competitiveness, with respect to the risk of taxpayer migration. We are in a totally new world now with respect to the loss of SALT deductibility. And then you layer on top of that the impact of the pandemic. There's a lot of uncertainty and a lot of reason for caution. So the proposal was designed with those various considerations in mind. And in that context, the executive chose a $5 million threshold as a starting point.
I'm glad you brought up the issue of taxpayer migration because no one's better to give us a sense of where that is right now. Can you talk a little bit about how how migration has or hasn't occurred since the start of the pandemic, and where are we seeing most losses when it comes to that issue?
Thank you, Senator. It is such an important question. And unfortunately, it is not a question that we right now as a tax agency have a lot of information on which to base an answer right now. And the reason for that is that 2020 taxes, the season for filing 2020 taxes is just starting. We'll see a bunch of filings by the April 15th deadline. And then after that, with respect to high income taxpayers, a lot of them file by the October deadline. So it really won't be until October that I think we have a complete picture of that 1 year impact. And even then, I would expect that it's an impact that we want to monitor over time. But there's no question it's something that we need to be watching very closely.
Sure, because one of the things that I can tell you we hear all the time is people are leaving. Some say people are leaving, some say people aren't leaving. And, it'd be helpful for us to have the data to really know what we're dealing with so we can make decisions grounded in fact, not grounded in opinions. So I definitely look forward. And quite frankly, as you're getting returns, I'm sure, you typically can say, you know, January, February, March, you have a sense of, based on historically, how things are trending. I think some of that information could help us as we're trying to think about what's really going on. So let's talk about the prepayment option for a second. One of the things that your proposal, the governor's proposal, says is you'll have a surcharge for 3 years, and then there'll be a tax deduction years going forward for 10 years, right? Can you talk about why you thought it was necessary to have the deduction piece of it? And, you know, do you have some reason to believe that we'll have the revenues in the future that this wouldn't cause us another problem, because now we have this deduction we have to pay for over 10 years while we're still trying to recover from and deal with the COVID crisis?
Sure thing. So the proposal, as you described, is a 3-year surcharge on the personal income tax, starting with taxpayers who make more than $5 million. And there is, as you described, a prepayment option whereby a taxpayer could pay in advance their taxes for 2022, 2023 with their 2021 taxes, and then benefit thereafter with a deduction that would in essence offset that liability. I think the thinking behind that is a recognition, first and foremost, that the most acute fiscal crisis is something we're seeing now in the state. I think we all hope and expect that we'll have economic growth coming out of the pandemic. Obviously, the shape of that recovery is something that it's very hard to have a crystal ball into, but we do know that we have shorter term fiscal challenges. And so the prepayment option provides an incentive to make sure that we're getting that revenue in sooner rather than later.
Understood. There are some concerns with the deduction, but I want to move on. The delaying of the middle class tax cut, one of the things that it's hard to reconcile is why, for the revenue that we believe we get from delaying a middle class tax cut, by the way, middle class, unless my numbers are wrong, goes down from anywhere from 20,000 up to 270,000. So middle class, I think, anyway, let's not talk about that. But my question for you is, why wouldn't we have just increased the income surcharge as opposed to delaying these middle class tax cuts to deal with that revenue that we expect to save from delaying middle class tax cuts in the middle of a pandemic? It seems, with all the concerns around income inequality and just what's going on in the world, that we would, particularly when you start at 5 million, I think most people would assume that those at the 5 million above level can handle sort of extra surcharges over those who are at the lower incomes scale, particularly in the middle of a pandemic. Can you explain the rationale behind delaying the middle class tax cut proposal at this time?
Well, I'll start by going back to a point I made earlier, which is it all starts with what we get out of the federal government. And so the budget is structured in such a way that, it's first and foremost dependent on what that number is in terms of federal support. And the governor has made clear his expectation that the state will receive $15 billion in support, which would obviate the need for these kind of tough choices. Now, absent that, though, tough choices do have to be made. And there is the high income surcharge, which will result in significant $1.5 billion in additional burden on our highest income residents, and a 1-year delay of the middle class tax cuts. Now, the middle class tax cuts will still phase in. Again, it's kind of recognizing the acute nature of this crisis in the short term in particular. But I think, the executive is aligned in saying that, we all hope that that's not necessary because the federal support will be there.
Well, I just want to say on the record that even if the federal support isn't there, I strongly object to the idea that we should be delaying middle class tax cuts, particularly for those in the $20,000, $30,000, $40,000, $50,000 income level. in the middle of a pandemic. I think that's a real problematic proposal, regardless of what we get. And I hope we get the 15 billion, let's be clear, but I don't think we should be looking at that. But let me move on because I think my time is running. Last question I want to ask you about is the extension of the Hire a Vet business tax credit. You know, one of the things that we've been talking about in my committee is the concern around tax credits that are not being fully utilized, even though we're looking to extend them. Can you talk a little bit about any challenges that you're finding as it relates to awareness around this credit, and what can we do to make sure that people use this credit? I'm all for the credit, but if we're going to have these credits and they're not being utilized effectively, I think we need to rethink from an oversight perspective what's going wrong and what we need to change. Can you talk a little bit about that?
Just to say that I would agree with you that it's a problem that we see across the board, where there are meaningful incentives that we provide through the tax code to particularly around hiring populations that we want to support. And we need to do what we can to raise awareness in the business community that those incentives are there. You know, certainly the tax department would be happy to work with you on those efforts, as well as you know, our sister agencies.
Real quick before my time runs out, do you believe this tax credit has been successful? Has it, leaving aside the issue that I'm concerned about, has it been successful? And if it's been successful, you would imagine that more people want to utilize it. Can you just help us understand that?
Yeah, I think for those employers that have chosen to use the credit, it has provided an important benefit that supports that hiring. So in those instances, it's successful in my view. The question is how can we repeat that success in more instances?
Thank you, Madam Chair Krueger.
Thank you, Senator.
Thank you, Commissioner.
So we will go to Assemblyman Ra, the ranker, for 5 minutes.
Thank you, Commissioner. Good afternoon. I wanted to get into the question of our state's convenience provision, and you know, with the fact that so many people are working remotely, and that there is a pending Supreme Court case stemming from a challenge that New Hampshire has filed against Massachusetts. Just if you have any information from within the department in terms of you know, how large the scope of the impact of this, are you concerned that if that case were to go in favor of New Hampshire, that it could jeopardize our laws with regard to those taxpayers, and how big is, you know, financially is the potential impact on our tax receipts?
So no question, there's been a lot of interest in the telecommuting issue as a result of the pandemic and the related shifts in work patterns. Fortunately, the state has long had a set of rules in place to address just this very question, this very question of how do we tax remote work. You referenced the convenience rule, and since 2006, the state has had guidance that effectuates that rule, that implements that rule, that lays out a set of criteria that employers and employees have to meet, and depending on those criteria, that will affect the tax treatment of those earnings. So those are rules we've had in place for a long time. Those are rules that have held up in court for a long time. Those and we're going to continue to implement those rules. You know, we're not changing anything on that front. So in that sense, I feel confident in our current policy.
Okay, thank you for that. The other question I wanted to ask you about, so one of the panelists during our hearing this morning that went into this afternoon was mentioning regarding Startup New York and businesses that had employees that were working remotely and were unable to report to those sites, and that are now being you know, told that they owe personal income taxes that they would not have otherwise, or businesses owing taxes that they would not have otherwise owed. I was just wondering if you can clarify that, from the department standpoint, but also whether it's something that could be potentially addressed administratively, or if it's something that would require perhaps language being inserted into the budget or in a bill to allow for those individuals working from home because of the pandemic to still get what they expected to be the tax benefits.
Thank you for raising that issue. I think I understand the issue as you describe it. I'm not familiar with the details from our perspective at the department. So if it's all right, I'll look into it, and I'd be happy to get back to you quickly on that.
Certainly, and if you'd like, I can kind of structure to you exactly what was raised earlier, so in an email or whatever, and that way you know exactly what you're responding to. I'd appreciate that.
That sounds great.
Great, thank you, Commissioner.
Thanks.
So we're going to go to the Senate then?
Thank you. Yes, we're going to call on Senator John Liu.
Thank you very much, Madam Chair. Thank you very much, Commissioner, for your testimony thus far. I just wanted to ask a little bit about the corporate taxes that, the governor has repeatedly said that we need to be competitive with regard to New York State's corporate taxes, because we don't want companies to leave the state of New York. And I agree with that. But at the same time, we are now faced with huge deficits, as the governor repeatedly points out, and everybody needs to share in the burden. So my question to you would be, how do corporations pay their corporate taxes to the state of New York? For example, do corporations that are headquartered outside the state of New York, do they pay corporate income taxes to the state of New York?
Yes, so the corporate tax, it'll depend on the tax type, right? So some businesses are pass-through entities, they pay through the personal income tax. There are a set of rules for sourcing or allocating that income to New York State as it relates to pass-through entities. And then there are actually a different set of rules for C Corps or corporations. And those rules were recently revisited in the corporate reform efforts that were passed through the legislature in 2015.
So, Commissioner, my understanding is that a simple way to look at it is that a corporation would be subject to New York State corporate taxes, no matter where they're located, based on how much sales revenue they get from the state of New York. Is that roughly true?
My understanding is a general matter, and I would want to look at the specifics, and we can maybe have a follow-up conversation, is that part of that 2016 reform was a shift towards what's called market-based sourcing, which is really based on that sales factor. How that sales factor gets calculated, depending on the company, the industry, that can end up being, quite complicated. But my understanding is that that is a major driver of our corporate tax base.
Well, it seems then that changing the corporate income tax rate or raising it because we need to raise revenue at this time, that wouldn't push companies out of New York, because no matter where they're based, they would still be subject to New York State corporate income tax. Is that correct?
Again, I would have to look at the details. This can be a complicated topic, and it can vary depending on the industry. But in principle, I think what you're articulating is accurate, which is that a market-based, it's one of the advantages of a market-based allocation
so
system.
It seems like there is room for us to raise the New York State corporate income tax without driving companies out of New York. Thank you so much, Commissioner. Thank you, Madam Chair.
Thank you, Senator Liu. Assembly?
I just have I think one or two questions. I don't see other Assembly members. On the film tax credit, just wondering, I see that there's the 1 year extension, but I was wondering if you have information about how the pandemic has impacted the film industry, and have credits disbursements decreased as a result, and then just the rationale for a 1 year extension.
I don't have those details with me. Assemblymember Weinstein, it's good to see you. I'm happy to go back and get that. The program is administered in the first instance by ESD. So we'll consult with them in terms of figuring out what the activity's been this year.
Okay, and then on the brownfields tax credit, do you know why the deadline is being delayed for the credit? And perhaps I don't think you would necessarily have it with you, but would you be able to provide us with a list of the entities that were unable to complete their projects by the current deadline?
So the brownfield credit is awarded in a way whereby the investments in kind of credit eligible expenses are eligible in a specified window based on when the project starts. And what happened was, because of COVID, that timeline totally got thrown up in the air. So in many instances, construction halted, these projects halted, and so a benefit that a project was banking on ended up no longer being available. So the purpose of this is just to kind of recognize that, extend that window so that there would be full eligibility for those projects. I can look to see what we have in terms of projects that would have been affected by this. And what I can say, however, is I'm not sure we'll have that data. Brownfield credit is something that is applied for after the fact. And so, companies complete projects and then they file it with their returns, either corporate returns or their personal income tax returns. And so we would know kind of upon filing, upon completion.
Okay, great. So look forward to, some of that information. And I think that's it for me for now. I'm going to turn back to the Senate.
Thank you. I see Senator Tom O'Mara's hand up.
Thank you, Chairwoman Kruger and Commissioner, for being with us today. What amount of savings is the governor's executive budget attributing to holding back the middle class tax cut?
I believe the fiscal associated with the delay of the middle class tax cut by 1 year is $400 million or around there.
And how much is the film tax credit annually in New York?
I believe it's also around $400 million, although the fiscal within the next year is zero. It's an extension out in the out years.
So the governor feels it's a better course of action to withhold a middle class tax cut than it is to continue over $400 million of tax credits to Hollywood?
I appreciate the comparison, Senator. I think it's apples and oranges insofar as one is about providing long-term certainty for an industry, again, has no fiscal impact until 2026. The other is an unfortunate but necessary action that would have to be taken if we don't get federal aid. Now, again, it's not the executive's position that anyone wants to see the middle class tax cut get delayed. That's provided important relief. It's been an important component of making our tax code fair and more progressive. It would be an unfortunate result if, in fact, we don't get federal aid.
How much more than the $6 billion that the governor's banking on would the state need to receive from the federal government to forego that middle class tax cut stay?
Ultimately, as the governor said, he is expecting a $15 billion aid from the federal government. There are a set of actions, including the 1-year delay of the middle class tax cuts, including the high income revenue raiser, including other issues on the spending side that are all contingent on that. How that plays out based on the amount of federal aid, I would refer that question to the governor, the division of the budget, and ultimately will be up to the legislature and the executive through the budget negotiation process.
I would submit, and if you could take this back with you, that the first 400 million above 6 billion that we get goes to provide that middle class tax cut in this next year. One last question in my time. What percentage of the annual state revenues are derived from the services industry.
I'm sorry, Senator, you just broke up there. I didn't quite hear you.
What percentage of total revenues of the state are attributable to the financial services industry in an annual basis?
I believe roughly 20% of the personal income tax is attributable to the financial services industry. But let me check that number and get back to you.
Would that be the single largest sector of revenues for New York?
I believe so.
You know, I share the concern with many others that increasing taxes on that industry, which would include those high earners that make up that industry, as well as the discussions of a stock transfer tax, would be detrimental to that industry. And we've seen certain financial service businesses leave the state for greener pastures. Others talking about it in the wake of these discussions of higher taxes. You know, what risk level do you assign to increasing these taxes on the financial services industry and those that work in the industry? How much is the risk that we're going to run them out of this state?
I think there is a great deal of uncertainty right now. I think that a combination, I think the impact of SALT alone on high income taxation in the state made this conversation very different than it was before in terms of what those effective tax rates are at the state level. When you combine that with the impact of the pandemic, which has totally upended how people think about residency, how people think about where to locate their work, changes norms, expectations around the workplace. I think there's good reason to be cautious around a whole number of these measures.
Well, I just continue to wonder, you know, which straw that we pile on the camel's back is actually going to break it. And I think we're near that breaking point, and we should be very cautious moving forward on anything that will really kill the golden goose of New York State. Thank you for your time today, Commissioner.
Thank you, Assembly.
Yes, we're going to go to Assemblyman Kale for a question.
Thank you. Thank you, actual real chair. Commissioner, I am uniquely interested in the administration of the Department of Taxation and Finance because I spent the first 12 years of my life in the very building that you're in, being part of that administration. I'm a little interested in the provision in the governor's proposal to increase the penalties on preparers and facilitators. It's a pretty significant and hefty increase for an industry that is populated in many instances by very low income people with you know, some level of training. Is there a compliance problem that is sought to be addressed here? And if so, is this the least intrusive way to improve that compliance?
Thank you, Assemblyman. We do think there's a problem in the tax preparation industry. A little bit of background, there are different categories of tax preparers. There are CPAs and lawyers subject to those rigorous training requirements. There are enrolled agents, which are agents that are certified, enrolled with the IRS, subject to continuing education requirements, examination requirements, oversight by the IRS. And then there are a set of tax preparers who aren't subject to any of that oversight. And what that really means is that there's a lot of opportunity for abusive behavior in certain segments of the market. Now, not every tax preparer is engaged in unscrupulous activities, but I do think that we have an interest as a state to make sure that there is oversight of the industry in those areas where there aren't other mechanisms for providing that oversight. I think it particularly has an impact on low-income communities. So what the proposal in the executive budget does is suggest a set of tools that would allow us to strengthen that oversight, and that would allow us to ensure a greater measure of transparency around taxpayer rights and around fees, with respect to how the tax preparation industry operates. And yes, I do think it's important, because oftentimes when a tax preparer does something improper or aggressive on a taxpayer's return, they have no idea, right? It's no fault of their own, but our only recourse as a department is to begin by scrutinizing that return. And so the taxpayer gets hurt twice in that context. So I appreciate you asking about the proposal. I do think it's important for us going forward.
Thank you, Commissioner. I've run out of time, but I have another question about sales tax receipts, and I'll hold off and I'll send that to you by phone. Thank you.
Okay, that sounds great. Look forward to it.
So we'll go back to the Senate then.
Thank you. And our next questioner is Senator Julia Salazar from Brooklyn.
Thank you, Chair, and thank you, Commissioner, for your testimony today. Wanted to start by asking again about the executive's PIT surcharge proposal. Do you believe that the full repayment mechanism outlined in the executive's proposal is actually necessary in order to retain the taxpayers who would be impacted, who earn more than $5 million per year in our state?
Thank you for the question. I believe, first and foremost, that it would help address what I indicated before, which is the most immediate challenge, which is the short-term fiscal challenge we have as a state. As to what's necessary for maintaining or foregoing migration or keeping the tax base in New York State, I think, again, it certainly helps. None of us has a crystal ball, but I think it would help.
And to follow up on Senator Benjamin's point regarding delaying the middle class tax cut versus instead implementing a more substantial or sustained personal income tax surcharge or personal income tax increase or increase on the tax rates on millionaires and billionaires, approximately how many New Yorkers would be directly affected by the delay in middle class tax cuts?
I believe it affects 4.7 million filers.
And by comparison, how many New Yorkers approximately would be directly impacted by the executive's surcharge proposal?
17,000.
Thank you. And the governor has proposed, the governor has proposed using federal stimulus funds to supplant state obligations, for example, in the state's education budget. Given that the federal stimulus is only a one-time funding stream and is not annual recurring tax revenue, or tax revenue at all, do you think this is a sustainable way to fund the state's ongoing costs and obligations, essential services? And how does the administration propose to address out-year funding gaps that would result from the practice of relying on federal funds rather than state revenue?
Thank you for that question, Senator. I appreciate that question. Unfortunately, I'm gonna have to defer answer on it. I'm really engaged in the collection of revenue, the administration of the tax system. That's a question that is really more about the structuring of the overall budget. So it's a little bit beyond my purview.
Certainly. Thank you, Commissioner. Appreciate it.
Thanks.
Assembly.
We do not, we have our real property chair for seconds, but did you want to go before that or?
All right, so I think it's me. And just double checking, does my budget revenue chair want a second round? Brian Benjamin?
Yes, I actually have a couple of questions that Julia Salazar sort of brought to my head. Sorry, Commissioner.
Wait. Okay, so we'll let the assembly go.
Yeah.
Oh, sorry. I'm ready. I'm sorry. I'm roaring ready to go.
All right, then I'll let you go and then I'll close us out. That's fine. Assembly.
Okay. Yes. Okay. So Sandy Gallup, you had 5 minutes for some additional questions.
All right, I was just going to follow up a little bit on the Office of Real Property Tax Services. And in our last discussion, you indicated, Commissioner, that the independent appeal wasn't, you wanted to take that responsibility over because the board wasn't timely. And I would just like to ask a question of the board. I know you're trying to change it so the majority is the quorum that's there. My understanding is you just haven't, the governor hasn't appointed people to the board. I think that's my first question. The other is, can't you have a board that conducts itself by Zoom, and then you can be much more timely with all of the issues. And I'd also like to ask about the hearings that you end up with no complaints and you'd like to not have those hearings. I wonder how many there are of those. Could you just give me a little background on this board?
Sure. So it's a 5-member board. It is my understanding is it's a legacy of when the Office of Real Property Tax Services was independent of the department. There was a merger of the two, but the board remained. There are 3 members currently on it. We are grateful for their work. They're fantastic and committed and do a really great job. It is not the easiest board to fill because it is not a paid position and historically has required a great deal of travel for in-person meetings. You raised the question of remote meetings, Zoom meetings. I believe that's something we've been able to do as an emergency measure during COVID. I'm not sure. I'd have to go check with my team here with respect to whether the law will allow us to do that going forward. But there has been a good deal of friction just in terms of getting those meetings together, getting a quorum, and getting kind of keeping things going. The board has many functions. This review of STAR exemption complaints is just one piece of it. I think I don't want to speak for the assessors, but I think the assessors are comfortable with the department playing this role. As I said, it's consistent with some roles we played in other areas across other tax types. And so I do think it's a proposal that we could effectuate to the benefit of the taxpayer.
All right. I'd just like to say I'm planning on recommending that you are able to use Zoom if you can't legally, because I really think an independent board is really important. Can you also tell me though about the local option requirements when we have exemption programs? And my understanding is you're trying to change this because the populations change. So you have an exemption that has a population in it, and all of a sudden, I don't know what happens. Does this happen often that you have a law that probably we've passed that just doesn't fit in with the population of the group?
So the issue is an exemption that's available to a certain population segment, or to localities of certain populations, and then they opt in, and then the population grows, so they're no longer in that population segment.
Right.
We've gotten that question: are they still eligible for that? Now, the intent is for them to still be eligible. I believe our understanding of current law is that they're still eligible, but there's been some confusion around the issue. I don't think it's been a ton of confusion, to your point, but there's been some confusion around the issue, so we just wanted to provide a clarifying legislative fix.
Has it come up many times?
I don't have the numbers, but I can get back to you on that.
Okay. And we have been talking about governors, commissioners, and staff and everything. Please do get back to us on issues.
Yeah, we're taking notes.
A really important thing for all of us.
We're taking notes, absolutely.
Okay. And are you going to be talking also with the assessors about merging the real property transfer forms that you have? It sounds like a really good idea. Westchester's already done it. They're in an e-filing system and so on. Do you have support from the local assessors about doing it that way?
I do believe there's a general level of comfort. I think the system as it currently operates is kind of archaic and could use some modernization, and there are 2 different forms, and we want to merge them together and make the whole thing kind of more modern and streamlined. So I do think there's local support. Of course, you are maybe the assessors will have a different view when they have the opportunity to testify after me today. But to the extent there are concerns, we'd be more than happy to engage and try to work through them. Because again, the point is to just streamline and modernize the current system.
Sounds like a good idea. Thank you very much.
Thanks.
To the Senate now.
Senator, I think you're on mute. Senator Kruger.
Brian Benjamin, do you mind if I take my first round and then you'll go in your second round?
I do not mind at all.
Okay, thank you. Hi, Michael.
Hello.
So you were asked about several things, but one of them that you brought up was SALT. And I know that we have a testifier a couple of panels down, E.J. McMahon, who's going to tell me that SALT didn't really impact the super wealthy because they were on the alternative minimum tax anyway. And so when you said you think that SALT had a significant impact on the taxes of the ultra wealthy, the 5 million and up people in New York State, what's that based on? I need to understand that.
So a couple of things. One is, I don't know if EJ would say that about those taxpayers. You know, the AMT is certainly a factor in terms of understanding the impact of SALT. Although the number of taxpayers affected by it, it actually depends on those taxpayers' individual circumstances, the deductions they take, et cetera. So there are a large number of taxpayers in that bracket who are affected by it. The second point I make is the AMT is much smaller now. So if you look prospectively at the impact of SALT on New York's competitiveness and taxpayer behavior, the AMT doesn't quite loom so large. So what matters right now is someone who is looking at their current situation and saying, do I want to stay in New York? Do I want to invest in New York? Or do I want to be someone else? Right now, the AMT is much smaller. And so the impact, the relevance in that context is diminished.
Okay. So I was asked to ask you, on behalf of one of my colleagues who couldn't be here, a couple of questions about, I think it's mostly, it relates to a proposal that he actually has. Sorry, I'm just trying to make sure. So I think it's his bill to recreate the stock transfer tax or a financial transaction tax. So his questions are, how much stock transfer tax was collected in New York State in 2020 before it was rebated? And then the second related question, and why was that amount of stock transfer tax collected? Why has it been decreasing over the last several years, since we look at the stock market and it seems like there's more stock transactions over the last few years? So why would these be going in conflicting directions?
So the state didn't actually collect any revenue related to stock transfer tax and hasn't done so since 1981. There's been a bit of confusion in this area, I think, so I appreciate the opportunity to provide a little bit of background here. There was a stock transfer tax in New York State that existed until 1981, and it was repealed at that time. The mechanism for that repeal, however, was by providing a full rebate of the amount of the tax for affected taxpayers. The reason for that was that there were New York City bond covenants that were covered by that revenue. So as a legal matter, they didn't want to actually take the tax off the books. But as a practical matter, the way that full rebate was effectuated was by no longer requiring that tax be collected at all. So instead of saying we're going to collect all the tax and then fully rebate it, the state made the decision not to collect the tax at all. There remain reporting requirements for the tax on the books, however, and so large broker-dealers continue to report through the clearinghouse. That's how the system was set up. So we get these reports, but they're basically journal entries. There's no money that changes hands. There's no bank account that's filled with $1 billion of stock transfer tax revenue that is then rebated. It's basically a journal entry. And as for why that the amount of why the revenue reported by those journal entries has gone down, it's simply that a number of large broker dealers stopped submitting those reports. And so it has no actual relationship to the underlying transactional activity.
So if in real life we did collect a tax, it conceivably would be significantly more than the reports we're getting show, because you're telling us that a decent number of the folks don't submit those reports anymore.
On a static basis, that might be true. Although I think on a dynamic basis, when you consider the effect that even a seemingly small tax would have on trading activity, migration, relevant location of jobs, I would just say there's a lot of uncertainty about that. And I'd be very cautious about banking on any revenue associated with a financial transaction tax proposal.
And has the state taken a look? Do most stock exchanges have transaction taxes?
Well, no exchanges, there are no stock transfer taxes in the United States. And so there's a very small one at a national level administered by the SEC that helps to fund the SEC's operations and operates on a relatively small base. But within the United States, no state imposes a stock transfer tax. And so that for one state to do that risk of migration becomes elevated in terms of that activity happening within the country.
And then there's another proposal. We've been looking at every single proposal that any legislator puts in. We're open to all ideas that could help New York State. But there's another proposal that's being called the mark-to-market proposal. Has that been operationalized anywhere? Are you familiar with that? And how would you do it if we actually passed it in the legislature? It would be up to you to ensure it was done.
From an administrative perspective, that has, again, not been operationalized, at least within the United States. There are proposals at the federal level to think about a mark-to-market, as you're familiar with the wealth tax concept, which has been floated by some at the federal level. And so some thinking, I think, has gone into it around there at the federal level, less at the state level, where, again, I think that risk of migration is more acute. I think from the standpoint of the department's capacity, that would be, like learning a completely different sport than the sport we're currently playing, because it would require reporting and then auditing of asset valuation in a way that is just currently not undertaken with any significant scale in the state.
And has the governor asked you to evaluate any of these new proposals that people are lobbying us around, advocating for? I know I have my finance staff trying to do the best job they can evaluating the who, what, where, why. Is that something that the governor's office says to you, Michael, get me the explanation of how this would work or how it wouldn't work and how much money we might see?
Certainly, we are in constant dialogue with the governor's office and with the Division of the Budget around a range of proposals, including proposals that have been put forward by the legislature. And so we engage in those activities when asked.
Whenever I'm asked about taxes and the need for more of them, I always say that I believe we do need more revenue, but I'm pretty agnostic about how we get it. The least disruptive way possible would be preferable. So under your assignment of doing work for the governor, are there any proposals that are least disruptive and most obvious that we could actually implement them?
Well, I think the governor has put forward his ideas of the proposals that could be considered as his executive budget, obviously all in the context of what the what we're all hoping and expecting to see from the federal government. Senator, I will say that another point to be aware of here is that we should be really proud of the fact that as a state, we do have a very progressive tax code, and one that does rely on high income New Yorkers to raise a very significant amount of revenue by some measures, including one I recently saw calculated by the Tax Policy Center. We are the most progressive tax system in New York State. Very generous benefits administered through the tax code for low income individuals. It's one reason I'm very proud to be the commissioner of the tax system here in New York State. And I think that system has actually served us relatively well in this pandemic. as we continue to collect revenue from those high earners.
Okay. Oh, I've used up my time. Thank you very much. Assemblywoman?
Yes, we have a member who's joined us to ask a question, Assemblyman Zoran Mamdani.
Thank you so much, Chairwoman. First, I just want to address Senate Chair of Budget and Revenue, Brad Benjamin. I just wanted to say thank you so much for co-sponsoring the Invest in Our New York Act. I just saw that today. I just wanted to say thank you. I grew up in your district. Commissioner, it is nice to meet you. My name is Zohran Mamdani. I am the Assembly member from Northwest Queens in Astoria, AD 36. I had a couple of questions that I wanted to ask today. And the first was, what annual income brackets do you define as middle class?
I don't personally have a definition of middle class. We administer the tax code as enacted by the governor and the legislature.
Okay, thank you very much. Additionally, my second question is, our current personal income tax system has 4 tax brackets with progressively increasing rates between $0 to $21,000 annually. However, after that point, the brackets become much wider and flatter with the same one tax rate applying to those who earn between $215,000 a year up to about $1 million. Can you explain how this fits into your description of this tax system as being an extremely progressive one?
Well, I think when you look at the tax burdens in the personal income tax as they fall on the residents in New York, you have the top 1% paying 40+% of the personal income tax. You have, the bottom 20%, 30%, 40% on net getting benefits out of the tax code often because of really generous programs we've set up around the earned income tax credit, the child tax credit, the child and independent care credit. So, on the one hand, we are collecting a lot of tax on the high end. I think when you add in the New York City income tax on top of that, a top income tax rate of 12.7% under current law, which is right up there among the highest in the country, and then the middle class tax that's fitting in, and then the really compelling, generous, progressive benefits that we provide at the lower end of the spectrum. I think that's why, in terms of these independent indices, we do end up looking very, very progressive relative to other states.
And I just wanted to follow up. You just said middle class. So what does that refer to in that description?
That's a colloquial. That's how the phase-in of the tax cuts that were enacted a few years ago by the governor and the legislature.
And what did those refer to in terms of income?
I think they start around $300,000 and have been increasing with inflation from there.
Okay, thank you very much.
Okay.
Senate?
Thank you. We have Brian Benjamin for a second round of 5 minutes.
Thank you so much, Madam Chair. So just a couple of quick questions. One is, I think we mentioned to you, Commissioner, a few of the Invest in Our New York Act proposals, 2 that have not come up thus far. It was a capital gains tax and an inheritance tax. Are you aware of those proposals, and have you given those any consideration?
I'm aware of the proposals. I can't say I'm specific with, I'm familiar with all of the specific details, but I'm certainly aware of some of the general concepts.
Got it. Okay, we'll talk about that offline. So let me go back to something that was an important point that I think Julia Salazar brought up. So you mentioned that 17,000 filers at the 5 million and above level, and that 4.7 million filers are impacted by the middle class tax cuts. Can you give me a sense and give us a sense, because I think this is an important issue. Can you give us a sense of what percentage of the tax revenue is generated by those in the 17,000 filers? What percentage of the revenue do they account for?
That's a good question. I know that the top 1% of filers in New York State generate, I think, around 44% of the annual revenue. Those above 5 million, that's not a cut of the data I've personally seen, at least not recently, but I'd be happy to get back to you with that information.
Got it. So, because I'm just trying to, obviously you're going to also get back to us with information on how the tax filings have been occurring, so we can get a sense of this taxpayer migration issue, which, by the way, we all have to be concerned about. What I want us to hone in a little bit on is, where's the trigger? So let's say, for example, the those at 100 million and above, which I think is a point that you were trying to reference earlier. Let's assume all of those people left. What impact does that have on our revenues?
That would have a dramatic impact on our revenues. I can't, again, I don't have the specific numbers in front of me, but if you just off the top of your head, a taxpayer making $100 million in a year, they pay 12.7 of that to New York State. Just that one taxpayer would have a meaningful impact, equal to, a very significant impact. So I think it is important, as we talk about the risk of high income migration, that we note that it actually doesn't take that many taxpayers to move the needle meaningfully, just because, for the very reason that the income tax is so progressive and is so geared towards raising resources from those wealthiest individuals.
I think it'll be helpful for us to get some more specifics on what you're talking about here. I know that this is something that comes up in the conference a lot. People trying to understand what, I feel like we too often have this conversation in theory and emotions. So it would be helpful if you can kind of lay out what exactly is involved here with these numbers. And there are there's a difference of opinion. A number of people believe that they won't leave if we raise taxes by a couple percentage points, and then some people say they will, but I think you need to let us know exactly what's happening on the ground so that we can take that into consideration with
I'd be pleased to continue those conversations and to be helpful in any way I can. I would say, though, that we are in a period of such significant uncertainty with respect to the state's economy and really the future of the national and the global economy. So again, the compounding effects of the cap on state and local taxes with the pandemic, where people have moved out of the state and they're deciding whether to come back, all the inertia around migration has potentially dissipated. So I think the level of uncertainty we have right now regarding the impact of tax changes on our tax code is as heightened as it's probably ever been. And I think at a minimum, that all argues for caution.
Now, the 4.7 million filers, what percentage of the tax revenue do they account for?
Again, I'd have to look at those numbers and get back to you.
Okay, so let me ask you a quick question for you. My time is up on the pass-through entity tax. So, what percentage of folks who are impacted by the SALT issue still will have issues even if we implement this pass-through entity tax? I mean, this doesn't cover everybody, correct?
No, definitely not. I mean, I think it's potentially an important step. It would affect taxpayers who earn their money through pass-through entities. So a certain type of business income could potentially benefit from the proposal, but other forms of earnings, wage earnings, capital gains, dividends, rental income, et cetera, wouldn't benefit necessarily unless earned in a way that was structured to benefit from the tax.
Got it. So we would still need the repeal of the SALT deduction for everyone else.
Okay. No question.
All right. Thank you so much, Madam Chair. And thank you so much.
Thanks, Senator.
Okay, Assembly?
I believe we are finished. And there's no further senators, correct?
Correct.
Okay, so Commissioner Schmidt, it's been a pleasure having you here. We look forward to some of your follow-up responses, and I'm sure that we'll be having continued conversations as we go on to negotiate the budget. Thank you for being here. We're going to now move on to our non-governmental witness. We're going to call witnesses. We're going to call panel A, which has been shrinking. We have the Fiscal Policy Institute, Dr. Jonas Shandy, Chief Economist. Mr. Henry, I believe, had to leave and may join the later panel. Susan Hurley is unfortunately ill, so the only other panel member is Strong Economy for All Coalition and Michael Kink, Executive Director. So if we could have those two folks here, and why don't we go in that order, with starting with the Fiscal Policy Institute. Yes, yes, you can begin. Yes.
Not hearing you.
We can't hear you, though you don't appear to be muted. Can you?
You hear me now?
Yes,
Yes, we can.
Okay, thank you. Good afternoon, and thank you for the opportunity to testify before this committee. I'm Jonas Schinder, Chief Economist at the Fiscal Policy Institute, an independent nonprofit research and education organization. This year's budget is historic in its challenge and opportunity. $15 billion is a very significant budget gap, and New Yorkers need a plan that will keep them afloat and set a course for rebuilding our economy for the lasting and shared success past the pandemic. To deal with the challenge, the state, of course, absolutely requires the federal government's assistance. But more can be done and more is needed. And with this said, we believe that the executive budget deserves to be revised, first for its unusual conditional scenario type of nature, and second for insufficient revenue actions that, in our opinion, seem to miss the mark in meeting the needs of the moment. So our written testimony details some of the identified practical solutions for the short term, totaling at the low end at $18 to $24 billion in new revenue. It's much longer, so I will not read it here, but you will see that there are some low-hanging fruits there, like PIT changes, the personal income tax, the GILTI compliance, and the look at the tax expenditures and corporate tax. Also, we believe that this moment offers relevance to policy innovations in the form of, just to name a few, the billionaire mark-to-market tax, the pied-à-terre tax, the vacant houses tax, some version of a data tax, and perhaps even a non-essential online deliveries surcharge that could work on multiple levels. The long-term objective should, of course, should include a more just tax structure, appropriate levels of state expenditure on education, housing, and public well-being, as well as providing relief to our cash-strapped local government, small businesses, and social programs. Unfortunately, we did not see much in the way of that in the executive budget. There is no single tax or single solution or easy answer to solve fiscal problems or challenge economic inequality, but the crisis does require bold vision and willingness to examine meaningfully the state's corporate and individual tax policies and change them so that they serve all New Yorkers. FPI looks forward to a productive budget process where all parties are working together on sound and responsible public policies all New Yorkers need and deserve. Thank you.
Thanks to the chairs and to the members of the legislature. My name is Michael Kink. I'm here with the Strong Economy for All Coalition. We're a coalition of community organizing groups and labor unions that has been working on economic, social, and racial justice for the past 10 years. I'm here to speak out strongly in favor of the Invest in Our New York revenue package that's been under some discussion today and during this session of the legislature. We think that New York needs tax policies that directly address our worst in the nation inequality. We need to tax high incomes, we need to tax wealth, and we need to tax corporations. And we need to have that progressive revenue structure in place, one, for reinvesting in the education, healthcare, transportation, housing, and just climate transition that all New Yorkers need. And two, to take advantage of the recovery that is likely to come after we get through the worst of the COVID epidemic. I agree with Jonas. We need a lot of help from the federal government, and we are going to get a lot of help from the federal government. The question is, after that money's gone, what happens next? Putting a sound, progressive tax policy in place across income, wealth, and corporate taxes will allow us to invest going forward. We won't just use up the federal money and then be in a hole. We'll be able to address decades of disinvestment that started at least in the Pataki administration and arguably since the New York City fiscal crisis of the 70s. I'll address briefly the myth of the moving millionaires. Cristobal Young's op-ed in the Daily News today, I think, was really important. In preparation for my testimony, I looked at WealthX, Knight Frank, Mansion Global. All of them reiterated the fact that New York is the only global financial center in the United States of America and has remained so during the pandemic. London and Hong Kong are our only global competitors for the super rich. I think the legislature can feel comfortable asking the wealthy, big corporations in Wall Street to pay their fair share. Finally, I'll address just briefly the constitutionality of the mark-to-market tax that was introduced by Senator Ramos and Assemblymember De La Rosa. I know there's been some discussion. Article 16, Section 3 of the Constitution does not bar a yearly income tax on economic gains. It bars an ad valorem tax that would tax a percentage of wealth every year, year after year, whether that wealth goes up or down. But the tax as currently formulated doesn't do that. It asks billionaires to pay an income tax on their investment gains. And New York has used mark-to-market taxation for the last 40 years in several sections of securities trades. We've done it, and it's been constitutional. Thank you.
Thank you. We'll go to Assemblyman Bronstein has a question.
Thank you, Chair Weinstein. For the gentleman from FPI, you mentioned the data tax. Just curious if you could just expand a little bit more on that, on what it would look like and how it would work.
Now, of course, the research is still ongoing, and there are many versions of this kind of a tax. It's a policy innovation. There are taxes on proposed taxes on collection of data. So each chunk of data would be valued, and that value would be taxed. Also, there is an idea in the literature currently being discussed where the consumer is engaging in a kind of a barter, a transaction with the Facebook, with the big company, the Amazon, and in return they get some kind of a service. So there's no cash being paid, and so that transaction becomes untaxed. So taxing that could be potentially interesting. So there are a lot of places that are trying their own version of a data tax, or are thinking about it. I know that some senators in New York Senate are thinking about this, and of course the ideas are varied, and there's no one way of taxing data.
Okay, it seems relatively new. It just piqued my interest, and I just wanted to see if you could give more thoughts on it. I'll talk to my colleagues who are working on it to find out more. Thank you very much.
Thank you. Senate, do you have anyone?
Anybody have their hand up? Brian Benjamin.
I want to thank Michael and Jonas for their testimony. I have a quick question for Michael. Thanks for your work on the Investment on New York proposals. One of the things that you mentioned, which is a constant issue of discussion, so I want to get your words, this from your own mouth on this. you mentioned the myth of the moving millionaire. I want to make sure I got that right. And you said that the only place that they can go to is Hong Kong. One of the commentaries that we've been hearing people talk about is they're going to Florida, and they're still keeping residences here, but they're spending more time in Florida so they can count in Florida's taxes, et cetera, or other states. What's your answer to that? What are your thoughts on that? And what are the insurances that you can give people who are concerned about the moving millionaire, that they won't move?
Well, the first thing that I'd say, and thank you for your co-sponsorship of the package today. I'll second Mr. Mamdani's appreciation. Look to recent history. After 9/11 and after the 08 and 09 economic collapse, we saw the exact same thing that we're seeing now. We saw people say New York was over. We saw people with wealth and means moving out of the city to other places. Real estate took a temporary dip. And in both cases, within the next 2 years, the entire market and the entire social, cultural, and economic infrastructure of New York was back in place. You can look to ancient history. People moved back to London after the plague. Right now, those studies show that for the finance industry in particular, London and Hong Kong are the only two other global centers of finance. Now, Cristobal Young, the academic that's at Cornell, looked at millionaire migration. He did a comprehensive study for Stanford and the IRS. He showed that most people that move are working class people and retirees, that millionaires don't move in response to marginal tax rates, and that every state that's instituted higher taxes on millionaires has gained in revenue and has not lost significant amounts of high net worth individuals. We've seen that recently too. ITEP issued a study, even during the SALT years, that New York, New Jersey, Illinois, California, high tax states have benefited. We have more millionaires in all of these big, blue, rich states than we had before. So it's something folks say a lot. I think that Cristobal Young is an expert. You should ask him to testify. You should have him talk to the conferences. His op-ed in the Daily News today is really illustrative. And I think you can feel comfortable making economic policy based on history and academic studies. We can do this.
Thank you. I look forward to speaking with him, and I'll reach out to you offline for his contact information. Thank you, Madam Chair.
Thank you, Assembly.
We do not have anyone, so we're gonna thank the two gentlemen, and we will move on to panel B.
Wait, I'm sorry. I thought that there might be an assembly person, and I texted and sent the message to Liz. She hadn't gotten it. Apologies.
No, I did not look at my text. I apologize.
No worries.
Okay.
Gustavo Rivera go?
Yeah, thank you.
Okay.
Thank you.
Okay.
I wanted to quickly follow up on exactly what you were talking about, since it is one of the main discussions. There's been no argument from anyone about the fact that during this pandemic, the wealthier had gotten wealthy. Nobody has been able to say that that's not factual. And it is also factual that working class people have been the ones that consistently have been asked to sacrifice during this entire time. And nobody can say that that's not factual either. So the thing that we have, the pushback that has been happening has been around this issue. It's like, no, we can't do this, because if we do, the wealthy will leave. And so I think that for the most part, you did cover that, but I wanted to dig a little bit deeper in the 2 minutes that we have about the fact that the folks who are leaving the state, and this is not just recently, but certainly when people say like people are leaving the state in droves, the people that are leaving the state in droves are working class people, many of whom would actually benefit from when we hopefully establish the Invest in Our New York package, and we get the revenue that we get there, then we can actually invest that money, whether it's on infrastructure, on education, on health, et cetera, the things that would actually make most working class people stay here and thrive here. So if you have 1 minute 40, kind of take us through that, particularly about the people who are leaving, who are working class folks or upper middle class folks that need the support.
I completely agree, Senator. You know, our statistics show that we have more millionaires now than we did in 2009 when we instituted the millionaires tax. We have double the number of millionaires, literally. So they're not moving, right? During the period when New York had the allegedly controversial stock transfer tax, we had the money for free CUNY, free SUNY, Mitchell-Lama housing, a public health system that people traveled to New York from around the world to see how well it worked, as opposed to how bad it is. We had public housing that was the envy of the nation, that allowed working class and poor people to grow up in dignity, raise families. All of those things were funded by those taxes on Wall Street and on the very rich. I would argue that the Pataki era, where we cut taxes for rich people, we pushed the costs of government onto the counties and created a rolling property tax crisis, and we slashed the social safety net when we cut our public institutions, that's what leads to the migration. That's what leads to the anger of the general public about New York being unaffordable. Millionaires and billionaires find New York eminently affordable. They are rich. They have no problems. The people that have high property taxes or high college tuition or can't afford the subway, those people are legitimately angry. And government can take a direct response with tax policy by moving money into public goods that benefit everyone, not just the rich.
Thank you, Mr. Kink, and thank you, Madam Chair.
Thank you.
We do have Assemblyman Roth for a question.
Thank you. And I appreciate your answers. It's an interesting, topic, and there's obviously a lot of perspectives as to, how we deal with this issue and what the potential impacts are. I'm just curious if you wouldn't mind elaborating on any thoughts on a couple of pieces of this. First off, that, maybe in sheer numbers, we have more millionaires, that the share of millionaires in our state has gone, relative to millionaires nationally, has gone down versus like a Florida that's gone up, by significant, double-digit percentage in that time. Any thoughts on that?
Well, Mr. Roth, I think that the question of whether we have enough rich people is, pretty clear. We have a lot. We have more billionaires than any other city in the world. We have more millionaires and billionaires than almost any state in the country. So I think that the growth and the dynamism of the New York economy at this point is pretty clear. Where our economy is bigger than Canada's, it's bigger than South Korea's, it's bigger than Russia. The question is, are all the people in New York benefiting from the wealth and the dynamism in the economy? And, I think taxing very wealthy people to invest in public goods that benefit everyone, that grow a middle class, that help poor people and working people gain income and wealth, is exactly the right way to do economic development. Our economic development programs over the last several decades have failed. We have low-income people and working class people that don't feel like they're getting what they need from government. And we have a ton of rich people that are doing just fine. So I think that you can modulate tax policies and investment and budget policies in a way that benefit regular people. What we've been doing literally for the last 25 years has been setting our tax and economic policies based on what's good for really rich people. And we need to turn that around. The constituents of yours that are angry about, property taxes or affordability, I entirely sympathize. The way to deal with that is to invest in public goods, to invest in aid to local governments, to make sure that the economic policy of this state is directed towards helping regular people. We don't have an economic policy like that right now, and I think it would be very, very popular if we did have one.
Okay.
9 out of 10.
I don't want to cut you off, but my time is running out. So I thank you for your answer. My concern being that, we are talking about a very small, so even if it's not a significant amount that leave, we're talking about significant revenue from a very small number of people, where even a small number leaving could have an impact on, whether those revenues come as expected. But I very much appreciate your thoughts during this hearing.
Thank you.
Thank you. Senate, do you have anyone else?
I do not see any hands, so let's move along to the next panel.
Okay, so we're going to say thank you, and we're going to move on to panel B, Empire Center for Public Policy. Edmund McMahon, Senior Fellow, and the Business Council of New York, Ken Pulaski, Vice President. And we can go in that order.
I'll go first. Well, good afternoon, everyone. We really appreciate the opportunity to appear today. Can you hear me okay?
Yep.
Okay.
Yep.
And we really appreciate the time you're dedicating to these hearings. I know it's a long day for everybody. In our limited time for oral comments, I wanted to emphasize several points that we raise in our written testimony. First, we recognize that the consensus revenue forecasting process required by state finance law is still underway. Its report is due this Sunday, February 28th. We believe that it's essential that the legislature assesses current and projected revenues from existing law and expected federal support from the pending federal COVID legislation before committing to any new state level revenue measures. To this point, based on Comptroller DiNapoli's most recent cash report, state and tax and fee revenues have been in recovery. And at the end of January, it actually slightly exceeded revenues for the first 10 months of fiscal 2020. We think it's important that we make a careful assessment of what our real needs are and what our revenues will be in the next year before we commit to do tax or fee measures. With a specific regard to provisions of the executive budget, I'd like to emphasize several points that we made in our written testimony. First, our strong support for the proposed pass-through entity tax, along with our recommended amendments that would make that mechanism more effective in securing full federal deductibility of state taxes paid by mostly small and mid-sized unincorporated businesses. Second, our support for a broader extension of eligibility timetables for brownfield redevelopment tax credits than what is provided for in the executive budget. This has been a very successful program for bringing properties back to productive use, especially in upstate urban areas, and we think it should be extended. Third, our opposition to amendments to the tax tribunal appeals process that will adversely impact small businesses and individual taxpayers in particular. And finally, our concerns about the adverse impacts that the extreme proposals for new and increased taxes being advanced by the Invest in New York coalition would have on in-state employers and residents. I expect, I think from today's hearing, we know that versions of those proposals, along with others from the literally hundreds of tax bills already introduced, are being advocated for inclusion in one House budget bills. We believe the need for significant new revenue measures to support the fiscal 2020 state budget is still unclear. But if there is an agreement that additional state revenues are needed, we look forward to continuing discussions with members of the legislature and to Senator Krueger's earlier point, to see what revenue proposals, what their revenue potentials would be, as well as what their economic consequences would be as well. We certainly look forward to continuing this conversation with members of these committees, as well as other members of the Senate and Assembly, as you continue to work through the executive budget and your own revenue proposals. So again, thanks for having us today. We look forward to your questions.
EJ, yes.
Thank you very much. Can I be heard?
Yes.
Okay. Thank you very much, Senator Krueger, Assemblywoman Weinstein, and other members of the Joint Committee. Thanks for having me. I'll begin by talking about just framing this as the pandemic has been this incredible disruption. I know this is said constantly, but I don't think it can be stressed enough. I think it's a much bigger, a much more severe, potentially long-lasting in its after effects disruption than 9/11 or the Great Recession or previous events since the Great Depression. And that's why so much caution has to be taken in the approach to the next budget and its tax policy. Even though the COVID outbreak was concentrated here, our tax revenues have rebounded more strongly than the governor projected and more strongly than other major states, because we're heavily dependent on an income tax and heavily dependent on income tax paid by high earners. In fact, we do tax the rich, quote unquote. That's why estimated payments in January alone were $1 billion ahead of last year's amount. The question now is, there's a lot of people on the fence about their continued presence in New York. You don't have to rely on me. There's a lot of excellent journalism on this going back to the spring when the Times was tracing movements of people out of neighborhoods, to business coverage now of what's going on with finance firms and real estate and landlords in the commercial business district. There's a lot of firms on the and employers on the fence about their continued presence. So the point is, don't push more people away. I got 3 recommendations, actually 4, that relate to specific budget proposals. One is, don't do the governor's surtax. His own updated receipt estimate indicates that it's not needed. Second, in order to ensure my popularity across the board on this panel, postpone the middle class tax cut not for 1 year, but for up to 4 more years. Third, repeal the film tax credit. And then a 4th idea, which I floated by you last year, is repeal the sales tax exemption on small clothing purchases and use at least half the revenue instead to convert it into a very significant increase in the child credit, which would do much more to help the families with children that the sales tax, in an awkward and inefficient way, were designed to help. Beyond that, I have data in my presentation that I won't detail now that contradicts some of the information that was presented to you in the previous panel, with which I strongly disagree. And I would suggest that this is not a typical situation. This is completely unprecedented in almost a century. And that you have to tread very carefully around this. And that in closing, I haven't specifically gone point by point down the agenda that's being discussed in the background here today. I would point out, this is not our usual discussion of how to increase taxes or raise revenues with the least possible disruption, as Senator Krueger said, which I agree with. This is about enacting a very radical package to dramatically expand government spending, which is far beyond what the state now needs. So I'll close there and be happy to answer any questions panelists have.
See a couple of hands. Helene.
Yeah, so we'll go to Chris Tay for 3 minutes.
Hello, Mr. McMahon. Greetings from your old hometown of Schoharie. It's good to see you. Being I only have 3 minutes, I'm going to just ask a couple brief questions and let you do the talking. So in your opinion, sir, what is your opinion with all the taxing of the rich or the wealthy, as we've heard today and we've been hearing from, in the last year? And secondly, what suggestions would you give to us as lawmakers as we go forward in the budget processing? What suggestions on how on what tax rates we use for different individuals, and what changes could we make in the budget, to help New Yorkers? Keeping in mind, which I don't think's been discussed today, is that before this awful COVID crisis, New York State was already facing a $6 billion+ deficit before we even got to these budget discussions. And it's always a pleasure talking to you. Thank you, EJ.
Thank you. In general, on the package, I think it's called Invest in Our Future package, and there's variants on it, including what was discussed by some people in the previous panel. I think what we're looking at here is an agenda that was developed primarily by Senator Sanders and Senator Warren and their supporters, and promoted as a federal tax policy, a broad policy designed to address inequality of income on the federal level. That's what all of this really springs from, beyond the usual attempts to raise New York's marginal rate higher on the highest incomes. And I think what we're not recognizing here is that this is a state. And I think that this whole approach treats New York as if it was a sovereign nation with a closed economy and that could tax with impunity. Now, ultimately, you can either believe that or you won't. I think the legislature needs to be very cautious in terms of the counterproductive and unintended consequences of treating New York as if it was a sovereign nation. In fact, as some of this analysis behind these proposals go, as if it were Canada. You can't tax like Canada. You're being presented with a plan that proposes raising taxes putatively by $50 billion, 50 billion with a B. That's beyond, you don't need $50 billion. That's about expanding the size of government by orders of magnitude beyond what you spend now in one of the heaviest spending states in the nation. So I think it's entirely unsuited to these times when everything is very much up in the air. I also think, again, and the state and local tax deduction was mentioned earlier, and with respect, Senator Krueger, I think maybe you're thinking of somebody else. I would not say that it doesn't affect the ultra wealthy. My point is it mainly affects the ultra wealthy. The ultra wealthy are beyond AMT range. And actually, the ultra wealthy in New York are really the people who are paying higher net taxes because of the loss of the SALT deduction. It's the first time in the history of the more than century history of the New York State income tax that it has not been fully deductible, nor the city income tax over 55 years from a federal income tax. The net tax price of New York has gone up very significantly. All comparisons to the past go out the window just because of that. And basically the pandemic is another change. So that's my reaction to that.
So EJ, even though it's not my turn, but the clock's over, I thought you showed me charts that the impact was people 400 to 500,000 a year, and that it really wasn't an impact on higher income than that.
I actually meant what we talked about when we had a briefing on this a few years ago was that the people in the sweet spot, if you will call it, of affluent households making in like 200 to 800 were primarily AMT payers who were being saved from a big SALT impact because the AMT has been rolled back very far. But I meant that group.
Okay.
And that, for instance, by dint of his own publicized tax return, the governor is in that group, and he actually got a tax cut based on his public tax return from the new federal tax law. It's the people at the top are pretty much beyond AMT territory, and they are paying more, and their marginal rate, which is what they pay attention to. The combined all-in marginal rate, even with a slight federal rate cut since 2017 on those people, is higher than it was. And that's before the pandemic. So that was the point I was making.
Thank you for some clarification on that. And
Lisa, you could
jump in.
We don't have any other assembly members, so you can.
Oh, well, we have a bunch of senators, so we're not.
Right, so just, unless somebody raises their hand on my side, just go through
Fair
yours.
enough. Okay, Senator John Liu. I see you, Brian Benjamin. I'll get to you next. Your hand wasn't up yet.
Thank you very much, Madam Chair. Thank you, EJ, for your comments, I guess. I just have to comment a little bit about what you've said. There is not a single one of us here who doesn't understand that we are one state and we are not a sovereign nation. So I just want to make sure that you understand that we understand that, and we don't need lecturing on that point. We understand that this is a state. But you probably understand also that in this country, wealth disparity and income inequality has been exacerbated in recent decades. It's gotten worse. And it is much worse and has gotten worse faster in the state of New York. So there's something that needs to be done at the federal level, but there are also things that need to be done in New York State, because we're not the national average in level or rate. Now, the Invest in Our New York package of revenue raisers, my sense is that it's probably not $50 billion, but it does raise a significant amount of money so that we can make our state even stronger. Education, healthcare, housing, these are the main things that people see in the strength of New York. My specific question for you would be on just one of the aspects of tax here. I had asked the commissioner earlier, the Tax and Finance Commissioner earlier, what the effect of increasing corporate income taxes would be in the state of New York. What do you think what would happen if we raised corporate income tax rates?
Well, again, I don't think it's a good time to raise any broad-based tax rates.
Well, there's never been a time that you were in favor of increasing taxes, right?
Well, I I think that, well, it would depend on how severe the situation was, actually.
Okay. So what would be the effect of increasing-
I think the effect, it would depend on what the increase was and whether it was targeted or broad-based.
A significant increase in corporate income tax
I
rates in
think
New
a
York State.
significant increase in corporate tax rates would not be favorable to hiring investment in New York by firms subject to the corporate tax. I don't think there's any question of that.
Well, according to the commissioner, based on his initial response, and he said he was going to look into it further, it didn't matter if the company was located in New York or not, that they'd be paying a corporate income tax rate based on their sales volume in the state of New York. And I assume that every company in the world, certainly in this country, would want to get a lot of sales volume from New Yorkers.
Well, you could catch them. You could catch them up that way, sure. I mean, if you wanted to look at it that way, the proposal I'm familiar with is one of several proposals that's designed to, in effect, in the description of its sponsors, to correct for what's considered too big a federal tax cut. I believe I've interpreted that correctly, and it's a very, very big. I don't know if you're talking about that one.
No,
that's a very
talking
large.
specifically about corporate income tax rate. It's pretty straightforward.
Okay. Well, there is a
Senator,
proposal.
Could I offer an answer, Senator? Because we follow the corporate franchise tax pretty closely. And I'd say two things. One is the Invest in New York proposal would be more than a tripling of our current corporate franchise tax rates to a level seen in no other state. And yes, if you're a non-New York based company who has an economic nexus here, you'll pay a state corporate franchise tax based on your sales volume here. But the other group of companies that will affect are New York State based corporations who are primarily located here and whose prime market is here. And since you can't discriminate based on where the taxpayer is, that would have an outsized effect on our home industry. So we would have very significant concerns. That's taking substantial amount of money out of New York State domiciled corporations. So we do think that would have adverse effect on New York State business and New York State's economy.
Well, you're arguing that any kind of tax would have an adverse effect. The question
not any kind of tax. We're talking about a tripling of the existing tax.
Whether these companies would move out of state and whether it would affect the employment base. Well, and it doesn't seem like you've responded that it would.
Oh,
I would say it would at the rate proposed in the invest in our future plan. That's a very big. If you're referring to that, Senator, that's a really big. Like all of the increases in that package.
It's a big increase that shocks your sensibilities. What if it was only 50% increase in the rate? Would that be more reasonable?
Never in the state's history has anything like that been done, or in any state's history. I would think that would worry you. And by the way, let me interject. When I talked about people assuming that bringing down a sovereign level tax plan to a state, I realize, and I apologize if you took it the wrong way. If anybody understands we're talking about a state, you assemblymen and senators understand that. The advocates, many of them clearly don't understand that, and some of their material makes it absolutely clear they don't. They think we can actually posture and position ourselves like a sovereign nation. That's been made clear. So that is some of the fervor behind this actually comes from people who think that. That's what I meant. So I want to clear that up and make sure I totally respect. You all know exactly what you're working
with legislators and not advocates today.
I understand. Well, but I'm talking to people who sponsored that package also. So I some of you, I believe, but that plan and several other plans follow a model that started with the so-called carried interest proposal, which the governor, unfortunately, or I think mistakenly advanced for several years, which said that recognize that New York taxes all capital gains at the same rate as normal income, as you know, does not favor one form of income over another. And that proposal was designed to essentially double the income tax rate or more on income classified as carried interest in order to get at those people who get it because the federal government should have been taxing them more. And I think that's a convoluted and ultimately counterproductive approach. And when it combined with all of the other things in the package, I think it really is an economically devastating approach. Ultimately, a lot of this in terms of what policies need to be enacted in terms of the nature of inequality of income and what government can and should do about inequality or income inequality at a federal level or a state level. That's a broader discussion that could go on all day. There's a lot of nuances to that. The question here is beyond.
Would you agree that marginal tax rates, federal and state combined, have decreased in recent decades compared to what they were, like, say, 30 or 40 years ago?
Of course they have. In the middle of that was 19.
And
But
in
then, well,
the same period, income inequality and wealth disparity has gone up significantly.
In
There's almost
1980
a very precise correlation.
would you agree that in 1986 we had the most significant federal tax reform of the century, which significantly broadened the income tax base, and thus
Well,
meant
those were
that
the Reagan tax cuts that we then
No.
paid for dearly.
No, that was a bipartisan tax. You're thinking of the 1981 Reagan tax cut. The
I have to-
1986
I have
tax
to
reform.
cut off this debate as much as
Okay.
I am personally enjoying it.
Okay, all
Because
right.
it has been pointed out that we're way past any clock.
Okay, sorry.
We
All right.
appreciate you being here, both of you.
No, but I would love to join you in this after this, after the hearing. I'm sorry, Helene, back to you, or do I just go on with more senators? You got any more assembly members?
No, it's just your senators.
Okay. And I'm guilty as charged for letting John Lou go on too long. Brian Benjamin.
Thank you, Madam Chair. I'm going to try to be more reasonable on the time. Let me start, though, with a question for Ken. Ken, you mentioned you had some revisions to the pass-through entity tax that you thought were of concern. Can you
Yes, sir.
please share like what that is and what your concerns are?
There's three, and they're in our written testimony. One, the governor's bill limits participation to partnerships and sub-S corporations whose partners or shareholders are natural persons. And we know corporate structures get more complicated than that. So it's an opt-in. We think any sub-S or partnership should be able to opt in. Other states have done it that way. It's a little bit extra complexity for the state, but we think that's manageable, and other states have proven it. Second, it applies the new entity level tax to a fairly limited share or category of the sub-S or partnerships income, and we're still looking in evaluating the IRS guidance on this, but we think that was in response to what the department thought the IRS was going to be allowed to be covered by these mechanisms. We think it's too narrow. We think it can be broadened. And third, the way the bill's structured is you would have to make your election 15 months before your tax filings are due. Other states, including some recently adopted states who've already gone this route, have allowed the taxpayer to make that election on their first timely filing. So we think that gives the taxpayer a little bit more flexibility. And frankly, I don't know that there's a particularly strong reason why the department would need the election made so far in advance. We think it's a good approach to relief to mostly small or mid-sized businesses. It's revenue neutral to the state. In fact, it generates a little bit of money to the state, and it's an election. So it doesn't work for every business, but for those for whom it would be beneficial, it allows them to opt in. We think it should. It deserves passage. I'd be happy to share I'll share the actual language we're offering offline.
Yeah, let's do that. I want to know more about that.
Great, thanks.
EJ, I wish I had 30 minutes to go to talk to you, but I'm just going to limit that to one question, which I want to make sure I heard you correctly.
Right.
So just so I'm clear, you said that we should not do a corporate surcharge on those making over $5 million a year of any
Right.
kind, but you did say in exchange, instead of that, what we should do is delay the middle class tax cut for 5 years. And just so I'm clear, in some language, some people call delaying of tax cuts a tax increase. Do you subscribe to that notion? And if so, are you saying that we should not increase taxes on those making 5 million or more, but we should increase taxes on those making between 20,000 and 300,000?
It would not increase taxes on people making 25,000 and 300,000. It is a delay of a
Delaying the tax
small.
cut.
It's the tax cut is actually worth a few dollars a week over a total of 4 years to people in median income brackets. And to answer the next question, I consider a median family income in much of the state is between $65,000 and $85,000. In the New York City suburbs, it's in the low hundreds. This is a very drawn out tax cut that is in the rates in different brackets that is delivering small savings to a very large number of people over a long period of time. That's why it has the cost it has. And what I do recommend, and in writing in my testimony, is that during a period of a suspension, because you should not be doing a tax cut, I would suggest in a period where you have a really severe budget gap that you're going to need to close especially once the federal aid you're about to get expires, and that this is a way of building up a reserve to help cushion the transition after the federal aid disappears. But I also recommend that you inflation index the brackets that were in that law so that during the period of the suspension, it will pick up with the same value. Now, I think that it's actually in the spirit of the approach the chairman described as the least disruptive way to raise revenue. It is by far the least disruptive way to temporarily raise a couple of $2 billion in revenues over the next few years. It's a very small savings for the affected people, especially in the 5 figures range below $100,000. And that therefore it is the least disruptive way to raise revenue during a period when the last thing you want is disruption. But nobody will pay more if you do that.
So that's my last question, Liz. I mean, because one of the things that we tend to focus on, we tend to understand is the impact, right? So
right,
the impact of what you call smaller numbers on those who make less is probably more severe than the impact of bigger numbers on those who make a whole lot, right? Just in terms of the impact to your lifestyle, et cetera. Do you accept that premise?
Well, when we're talking for a family and making $62,000 or so, of $94 between now, of $94 4 years from now, I would say that's not a big impact.
And not that I'm supporting or opposing the proposal, but we ran some numbers the other day just because I was curious as to what the effect was. I believe at about 120,000 in taxable income, the change in year one was $120. At lower incomes, it's obviously quite a bit lower than that.
The figures we're talking about delaying a tax, in percentage terms, the changes in taxes paid by people targeted by the remaining years of the middle class tax cut are not nearly as large as what's being proposed in the very top income ranges. And again, to answer some questions earlier about progressivity, some charts are included with my written testimony. The tax code, it's very steeply progressive, our tax code. The average taxpayer,
no, you know what? Now I'm guilty of letting you and Brian Benjamin outrank John Liu in the time issues. Which makes Brian happy. But now I'm going to jump to Tom.
You could say I'm the chair, so I got a little extra.
That's right.
Yes, I agree. Take
all
the
right,
floor back, Madam Chair.
Yeah, I covered my problems. And now we're going to let Tom O'Mara wax poetic with you for 3 minutes.
Okay.
I'll yield my time to make up the end of that other conversation, but no, I only have 3 minutes, but it's all very interesting. And
we will all look at your charts, EJ.
EJ, if you could discuss for a moment I think there's a common perception out there that the wealthy don't pay their fair share, that they pay a lower rate overall than middle-class taxpayers. So if you could talk about that, that paying their fair share or what their rate is on that higher income, and also who stands to gain the most if we were to reinstate the SALT deduction. What range of taxpayers would benefit the most from that?
Well, the answer to the last question, that would be the very highest, the multimillionaire earners would gain the most from reinstating the full SALT deduction. That again, as I was saying, and there's charts in my attachments, which are based on state tax department data. The lowest 4 income quintiles, the lowest earning 40% of New York resident taxpayers, basically don't pay collectively any state tax. They collectively get refunds. The figures are very low until you get to the 80th, up into the high part, near the 80th and above the 80th percentile. The top 1% of state residents pay nearly 44%. Top earning residents pay 44% of the state income tax. The next, the 10% right below them, they pay a very high share as well. And there is no modeling that's ever been done of state income taxes that doesn't find New York's among the most progressive in the country. Another factor, we have a very favorable treatment of low income payers in New York State. This was contrary to the revisionist history you heard earlier, and I have to call it that. This was because of policies enacted at the end of the Mario Cuomo administration and through the Pataki administration. That tax cut expanded significantly on an earned income tax credit that benefits the working poor. That was initiated at a low level under Mario Cuomo. It was repeatedly increased under Pataki. Pataki's tax cut taxes twice as much for the median income as at the top. It actually brought about a further shift of the remaining tax burden to high income. It actually shifted more of the burden from the middle to the top. Our reliance on the top 1% by all the data that the budget division has produced over years increased after the Pataki tax cut was passed. So if you look at comparisons of state, our treatment of people making below median income is the most favorable or among the most favorable of any state. That's just a fact. So, and that's good. It's good policy. It's policy that I wrote about and cheered on at the time in different roles I was occupied in.
Do I get any more time? One more question.
One more question, quick.
One more question. EJ, if you have it, figures for the high wealth tax proposal that's out there for people over $5 million. For every one of those taxpayers leaving the state and us losing that income tax, how many median tax-paying households would it take to make up that loss?
Well, keeping in mind that the median household is at a different place in different parts of the state. For instance, in your district, it would probably be the $60,000 to $65,000 range. People making between $5 million and $10 million a year, they pay an average of $544,000 each on average in state income tax. That's the same amount paid by 202 households, median income households. When you get to the $10 million and above range, and that's as high as the data available go, they pay an average of $2.5 million each in state income tax. That's as much income tax as is paid by 940 households making between 60 and 65. If you lost just 100 of the roughly, I think, 2,700 households in that bracket, that's as much in taxes as paid by more than 90,000 households making between $60,000 and $65,000. It's a lot of money, and no, anticipating a question just quickly, the income share is not as much outsized as the tax share. It's big, but it's not that. It doesn't match the tax share.
Okay, I've been fired now as a joint co-chair because I let this all get out of control. I'm not using up my time. I'm not going to have questions. You guys got my time, but we do have Julia Salazar to close.
Thank you, Chair. I have to quickly follow up on a comment that's been made in your testimony, in which you claimed, as a matter of fact, that the package of legislation that's been proposed was designed to emulate federal level proposals by Senator Sanders and Senator Warren. I'm a lead sponsor of one of the bills in this legislative package, and have been working with the other lead sponsors. And I can tell you firsthand that that statement is false. And I just want to remind every witness who's testifying today that while I do not expect us to agree about proposed solutions to what is undoubtedly an economic crisis and a massive budget deficit, I do, however, expect your testimony to be truthful. And I know that the chairs expect your testimony to be truthful and to be accurate, and that your testimony in these hearings is public record. You mentioned in your testimony that you believe the need to raise state revenue at all in the upcoming budget is still unclear. What conditions would possibly make the need to raise state tax revenues clear, in your opinion?
I know I said that, so I don't know if you're addressing it to me, but thanks for the question, Senator. I mean, by the end of this week, there'll be, well, the schedule is to have a consensus on revenues. And, you know, we don't have the inside information that, you know, Senate Finance might be privy to, but looking at the published reports from the Comptroller's Office, I think it's pretty remarkable how resilient state revenues have been. If those trends continued as, you know, additional venues, particularly in the city, reopen, we see, you know, with you know, more return of office workers to the city. I mean, I think all indications are we're going to see an even sharper rebound of state revenues going into next year. And couple that, so we'll have at least we think we'll have an agreement on what the expected revenues will be shortly. In addition, Congress seems intent to pass the Biden COVID package by the 14th of March. My understanding is that the amounts and distribution of that are pretty well locked in. It's either going to happen or not, but the numbers are known. I think looking at those combined resources together, I think it you know, what we would like to respond to is, given what we know and what we expect in revenues, what more, if anything, is the legislature and the governor, you know, interested or in proposing to spend? And I think from there we can talk about, you know, what's the best way, how you can do that again with the least amount of unintended collateral damage.
May I say something? I'm sorry. Senator Salazar, with respect, you've impugned my honesty, and I'm sorry, but you're wrong. If the plan you're supporting and other elements of it do not resemble closely positions advocated at the federal level, principally by Senator Sanders and Senator Warren, who have a right to advocate those positions. They're the primary proponents of such positions. If they were not inspired directly or even indirectly by those proposals, there's a remarkable resemblance. And I'm not going to, that's not untrue to observe. And so, and I don't see why I'm surprised you even mind the connection. Why wouldn't you want to have your proposals compared to those proposals? I've been reading the material very closely from that camp for years. And it's very similar. The rhetoric and the goal and the need to address income inequality that's stressed in all of those proposals, it's virtually identical. I'm surprised you even disagree. So that's my answer to that.
So just to, if I may, Chair, sorry, just very briefly, the point is rather a disagreement in the fact of what inspired the proposals and the process of drafting the legislation. But additionally, I do think it's important that we distinguish between the nature of a federal proposal based on the law and what is possible, a federal proposal versus a state proposal. So to me, that was the significance and the difference.
I agree. And what you've proposed is many, many multiples of the largest tax increases that have ever been proposed in the history of New York State.
Thank you. No, I just was thinking that we've had enough back and forth with some of our colleagues. Perhaps we should move on to the next panel.
Which is about weed. It's much more relaxing than tax
policy. Okay.
Thanks for your time.
Thank you very much.
Okay, thank you both for being here. So panel C, New York Cannabis Growers and Processors Association, Alan Gandelman, New York Medical Cannabis Industry Association, Ms. Betty, I'm sorry, you'll have to pronounce your first name for me. I didn't want to mess it up. And Sam Action Inc., Kevin Sabat. And if we can go in that order, that would be great.
Okay.
Hello, my name is Alan Gandelman, and I'm the president of Head and Heel, a New York organic vegetable farm, hemp grower, and processor. I'm also the president of the New York State Cannabis Growers and Processors Association. The NYC GPA represents New York businesses that produce high-quality hemp and cannabis products. We deeply appreciate the possibilities offered in the MRTA. New York will need to balance issues involving taxes, licensing, and speed to market. The MRTA does an excellent job allowing for social consumption, cannabis home grow, micro businesses, home delivery, and funding for social equity applicants. These policies should be without question integrated into any final legislation enacted by the state. Our tax analysis of the MRTA and the CRTA shows that the CRTA has potential to harm smaller businesses. We have seen repeatedly that fixed rates in a mature market benefit large companies that can operate at a smaller profit margin. The effective tax rate in the CRTA, depending on the product, is between 30 and 50%. This will drive consumers to the illicit market or across state lines. Massachusetts is more competitive currently with a 20% rate. The MRTA provides a better alternative with a percent-based tax on real market values. The 18% tax it creates will help develop a competitive landscape where smaller businesses can thrive. For distribution, having a required distributor layer in the supply chain will have negative unintended consequences that will harm small entrepreneurs. Forcing cultivators or manufacturers to go through large distributors and getting their products to market will squeeze profits from small producers and prevent retailers from dealing directly with the source. In terms of licensing, from cultivation through dispensaries, that should take top priority. New York will need at least 5 million square feet of cultivation capacity. We have an opportunity to have hundreds of farmers create enough supply to address the existing market, which will need 2,000 dispensaries across the state. This estimate is modest. For comparison, New York currently has 3,300 liquor stores and a lot more than that when you consider places selling beer. Speed to licensing is also extremely important. We have seen several states struggling with getting their licenses into the hands of small businesses, while states like Arizona stood up their adult use market within 3 months by leveraging existing infrastructure. New York has a key advantage that other states did not: existing hemp farmers and processors ready to start in the adult use industry from day one. Amongst us, we have a current capacity to meet the needs of New York by January 1st, 2022, and provide supply to all New York retailers. To address these issues, we suggest legislatively mandated deadlines, putting a time frame on licensing for all classes. As we have seen in both the medical marijuana and the hemp programs, the slow rollout of regulations negatively impacted both patients and businesses. For reference, after a year and $1 billion in sales, Illinois still does not have one Black-owned cannabis dispensary. We cannot allow this kind of regulatory oversight to happen here. We believe a legislative mandate on these issues will avoid problems that other states have experienced, especially related to small businesses and social equity applicants.
Next, the Medical Cannabis Industry Association. And can you just pronounce your first name for me so I'll know for the next time?
It's Nigist, rhymes with biggest, so that's Nigist Abebi. So good afternoon, everyone. I am the Director of Public Policy at Columbia Care, a New York headquartered and licensed medical cannabis operator. I also serve as the president of the New York Medical Cannabis Industry Association, which represents 8 of the state's medical cannabis registered organizations, or ROs. We aim to protect and serve medical cannabis patients and help establish a safe, well-regulated, and equitable adult use program. The association enthusiastically supports efforts to regulate cannabis for adult use. And in particular, in New York, we have the opportunity to set the gold standard, which is why it's so important that we get this right. We think that the medical operators already invested in New York facilities, jobs, and serving New York patients can help support the social equity and economic goals underpinning these legislative efforts. We do feel that there's a sense of urgency given neighboring states' progress towards legalization and the potential for federal normalization on the horizon. And as the adult use proposals currently stand, the MRTA has critical elements that the association supports, including comprehensive social equity policies and key improvements to the medical program, such as adding whole flower, which I outlined in more detail in my written testimony. Specific to today's focus on revenue, I would like to emphasize that the RFP auction process included in the CRTA will primarily serve to significantly delay revenue and job growth, while also undermining social equity principles. Among current standards for cannabis legalization policy, the RFP process in the CRTA uniquely fails on a few fronts. It delays tax revenue and job growth. In particular, when it comes to including the ROs, New York has already run a competitive process to determine that the current ROs are able to cultivate, process, and sell medical cannabis and abide by regulations, which we've done for years now. The time-consuming RFP process delays any ability to initiate adult use sales and start investing in new jobs and new infrastructure. The process also would delay social equity, allowing the existing processors to be assessed a license fee for the privilege of remaining operational in the adult use program could seed the state administered social equity fund immediately, which is a concept included in the MRTA. And lastly, the process would leave patients in the lurch. Without adult use co-location, medical operators will not be able to survive in an adult use market. Pediatric patients, any folks in hospice or other institutional care settings will not be able to access, much less afford, medicine in the adult use program. The revenue focus, we believe, should be on bringing medical ROs and social equity licensees to market as quickly as possible to focus on generating the tax revenue, the job creation, and meeting equity goals simultaneously. Our industry supports nearly 1,000 jobs and has made considerable investments to serve New York patients, and we want to continue to serve New Yorkers by helping New York get adult use right. I look forward to entertaining any questions and appreciate your time and consideration this evening.
Next, Sam, action.
Thank you, Madam Chair. My testimony tonight is based on my own experience and that of over a dozen top scientists who serve on the advisory board for SAM, Smart Approaches to Marijuana, which I co-founded with former U.S. Congressman Patrick Kennedy. We're the leading nonpartisan, nonprofit national organization based in New York now, offering a science-based approach to marijuana policy. I recently served in the Obama administration as a senior drug policy advisor, and I'm an adjunct professor at Yale University. While we should remove criminal penalties and continue to do that by not penalizing people for use, while we absolutely should expunge records and invest in prevention and treatment, generally the legalization of marijuana is bad policy and should be opposed. Scientific literature on the harms of marijuana use exists in abundance. I'm not going over that for my testimony tonight, but if you're interested in that, the most latest review was by the Independent National Academies of Sciences, which reviewed over 20,000 peer-reviewed research articles linking both marijuana, but also the legalization of marijuana to severe negative outcomes. There are really three big issues here specifically relevant to the Budget Committee that I want to bring up. First is outcomes like hospital admissions due to high potency THC ingestion or increased poison center calls should absolutely be expected, especially in the beginning of legalization. This has happened in every single state that's legalized without exception. These would incur real costs in New York at a time when our hospital capacity is at the brink at a time of a major pandemic. It doesn't make sense to stretch those resources even more. The second point is, for states that have legalized, revenue for marijuana sales often accounts for really less than about 1% of their overall budget. Colorado marijuana revenue, for example, represents 0.9% of the state budget. California is much worse. There's a thriving black market that does not go away when you legalize the drug. And there are costs as well. So it's not just revenue. Of course, we have to count the costs. A study in Connecticut, for example, found that the costs associated if they were to legalize marijuana, and it's definitely not a sure thing that they will this year, would total more than $200 million, while revenue would be around $100 million. Legalization would result in a variety of also unquantifiable costs as well. And while our neighbors over in New Jersey may start to rake in a few bucks in a couple of years, they will also have several costs that we must take into account. The third point is really, I agree with the first person testifying that we should look at that Illinois example. It's really the only other state other than a Vermont and a modified version that's legalized marijuana through the legislature. They said they'd be the standard for social equity, and yet they have not one major minority license holder. Everything is going to wealthy investors. Big tobacco is now a major investor, also big alcohol, and there's absolutely nothing to hold them back. They are already lobbying for legalization, Altria, Philip Morris, that is, in Virginia, as well as in DC on Capitol Hill. And we know who will be making profits if legalization passes here in New York.
Hold on one sec. We do have a few members. If we go with Assemblyman Ra.
Thank you. I was wondering if the panelists could just weigh in on something for me. Obviously, we're considering this particular proposal. There were just some changes proposed in the 30-day amendments with regard to distribution of revenues, which I assume was meant to get the governor's proposal closer to the proposal we've seen in the legislature. And, you know, there's a lot of talk of equity funds and things like that. But, you know, the last panelists just mentioned, you know, one such cost, you know, with poison control and things like that. But what your thoughts might be on there being some set aside of revenues to deal with costs like that, to deal with potential public safety costs, you know, like training of drug recognition experts, things of that nature, which is expensive. And last week we had or 2 weeks ago, we had a hearing with local governments. And I mean, the number of trained drug recognition experts amongst the largest police departments in our state, I mean, it's close, a handful. So there's going to be a huge need there, and it's going to be expensive.
Well, there's going to be a huge need, Assemblyman, and there will never be enough. I mean, DREs, there can never be enough drug recognition expert officers to be able, and I'm sure everyone's familiar with the term, to be able to identify drug to drivers. Marijuana affects everybody differently in terms of their driving ability and their system, although scientific research now says it about doubles your risk of a car crash. We know that the unfortunate limo crash a few years ago, the driver was positive for marijuana. We know several of the Amtrak issues were related to marijuana. So I do think it's a big issue. A drug driving fatality costs about $1 million in lost social costs. And I think we can't underestimate also the administrative costs, the regulatory costs as well. I haven't seen one state deal with that particularly well in terms of being able to distribute that. It usually goes to a general fund. There are often promises that it will go to prevention and treatment and things like that. But again, I haven't seen that well. I've certainly not seen it be reinvested, as we're hearing, in communities that have been hurt by the war on drugs. Frankly, the communities we work with that are a lot of very vulnerable communities, the last thing they want are pot shops in their community, just like they don't want liquor stores in their community. It doesn't help them. It doesn't raise, you know, it doesn't help their youth. It doesn't help raise real estate prices. And they see it as just like those payday cash shops. And I'm sure most of you know, the majority of localities in states that have legalized have actually banned marijuana sales altogether, and they don't want the revenue because they know it comes with considerable costs. So there are a lot of considerations there.
I think if you look at the MRTA, there is a portion of local sales tax revenue that does go to the local municipalities. So if they want to spend it on enforcement, et cetera, they could. But I do think we need to realize that these are already issues communities are dealing with. All of a sudden, because we're going to have an adult use program, does not mean the rates of use are going to skyrocket. That is just simply not true and not what we have seen in other states. I think the bigger issue is that we still have a social equity piece happening in the city. So for Mr. Sabay to say that, oh, these communities, they don't want this, they don't want that, I think, you know, that's really not fair. And I think we should be letting those communities speak for themselves when it comes to this topic. And I don't think making those sweeping generalizations is really fair to anyone. That being said, the amount of jobs and revenue this will create in those communities, especially if we allow social consumption and home delivery, is astronomical. The last revenue report that came out, there was an independent study that came out last week that was citing 50,000 jobs. I mean, this is not a small number of jobs, especially affecting communities that have been impacted by the war on drugs.
Yeah.
I do want to, I just want to interject here. The legislature bill addresses some of this revenue commitments as well.
Okay, we are going to go to the Senate. Lucy, you're muted.
Thank you. So I think everybody knows I am the lead sponsor in the Senate of the bill being debated. And it's not the intention of this hearing to per se be a MRTA hearing. You know, I appreciate Kevin's continued advocacy against the bill. He's been a consistent, I don't know, I'm starting to think voice of one to continually tell me this is all wrong. And I'm happy to discuss it with whomever, but I don't think you actually want me to tonight. So I'm not going to, other than to urge people to take a look at the actual bill, take a look at the comparisons between the proposal the Assembly and the Senate have. It's the same as bill in both houses, MRTA, and take a look at what's going on around the country. But I certainly don't think you will see large numbers of communities pulling out of the program once it's started. And I do just want to remind everyone, all the concerns that they may have about marijuana, and it's legitimate, concerns about any kind of mind-altering drug, whether it's alcohol or marijuana or a dangerous addictive drug, that there are prices that come along with it. I completely agree. The thing is, here in New York, that's already been here forever. We're the largest marijuana market in the country by far. It's just none of it is legal or regulated with any attempts to make sure that it's safe product or that there's a limitation on the strength of the THC or that you're going after people who are violating your law. So my position is we already have it. Should we be doing it right? And people can welcome having different positions. And
Well, Senator,
yes.
If I can, I commend you actually, even though we are on opposite sides of this issue, clearly, I do commend you for being honest and forthright about the dangers and the cost and saying publicly, even though it may not be in the interest of the bill necessarily, but saying publicly that this isn't going to solve budget issues, and it's going to take some time, and we have to be sort of, honest and direct about it. I think the reason why, and I'm flattered that you think it's just me, but joined by, the Medical Society of the State of New York, which is firmly behind our efforts, as well as the New York State PTA, and many other groups, by the way, law enforcement groups, public safety, public health, parent groups who are joining in opposition to just the general effort, either effort to legalize marijuana, is that what we're concerned about is not so much taking the legal market and just saying, okay, if let's say 10% of New Yorkers, use marijuana, we're going to just shift that over to the legal market, and then it'll just be an easy shift. What our concern is going to be, and I have to take issue with Alan's point, there was just a study yesterday about California youth use increasing after legalization. The issue is, and it's not just youth, it's other ages too, that we're going to add to it. It's not that we all think that it's going to go away or we don't have a, like you said, a robust marijuana market now. We do. I'd personally rather have, 7% of New Yorkers, engaged in a marijuana market that might be illegal than 30%, engaged in something that's controlled by big tobacco and big alcohol. That is a trade-off. All policy is trade-offs, and someone could disagree with that. But the worry is not so much that there'll be like a one-to-one shift. The worry is that we're going to see costs mount and there be a dual market, actually a triple market, a illegal market remaining, a legal market, and then a gray market. And the gray market we've seen, for example, in places like Colorado, big time, where you have, people and distributors buying legally, selling illegally because it's still illegal for kids and, after hours and that kind of thing. So I think those are the concerns, especially when we start talking about delivery services, on-site consumption, pot bars generally. These are some of the, concerns.
So I think we agree on one thing, is that we don't want to see an industry controlled by large tobacco companies. And that's exactly what my testimony is about. You are on point 1000% there. We want to see a small, decentralized, local system benefiting small business owners, small entrepreneurs, benefiting the people that have been harmed by the war on drugs. That's exactly what we would like to see. And that's exactly what we're talking about here.
I want to echo the point that it does not have to be inevitable who owns, and there's a lot of avenue here for the state to be determining who is participating in the future cannabis market. And while some people might be comfortable with 7% of New Yorkers being exposed to policing risks and other side effects of the war on drugs, I think others would like to start to see a regulated market and revenue being generated to address those very same policing costs.
If we think we're not going to have police intervention,
All right, my
we
time
think
is up, actually, guys. The clock just went off, so I'm going to hand it back to the Assembly. Do you have anyone else, Aline?
Yes, we do. We have Assemblyman Cahill.
Thank you. I'd like to, excuse me for doing this, but I'd like to bring it back to the budget. And there is a proposal in the budget by the governor for legalization. And if I am not misunderstanding the conversation that I just heard, I think we have a panel of 3 people who are opposed to the governor's proposal. Is that a fair, just with a nod of the heads, is that a fair consensus?
I think we believe the governor's proposal could be improved as well. And that between the CRTA and the MRTA, there's a pathway to effective legalization in New York.
Okay, and the second question that I had is the MRTA bill provides for a significant amount of the resources that would be derived from the bill to be specifically dedicated to purposes other than puffing up the budget, and pardon that pun there. But it's intended to enhance programs for prevention and treatment. It's intended for reinvesting in communities. It's intended for a variety of purposes that do not tout marijuana as a revenue producer and therefore make it as attractive to the state of New York as the lottery has become. Let's not even talk about alcohol for a minute, but lottery has become, as I call it, a tax on stupidity. And it seems like we could be heading down the same path if marijuana becomes primarily a revenue raiser. What other measures do you think we could take to assure that if we have a marijuana market that is legal in New York State, that ends the horrible impact that it's had on a number of communities because it is illegal? What could we do to assure that it is the most responsible market in the United States of America?
Well, there are a lot of things that could be done. And I think, we're not trying to be unproductive here and just be kind of, no. Although we don't like it, we stand with every major medical association in the country in opposing legalization. However, I think even Senator Krueger mentioned the idea of potency limits. There's no reason why you need to sell 99.9% shatter, which has, we're just beginning to learn what even the short-term impacts of that are, let alone medium to long-term. We can look at child packaging, warning labels. It makes no sense to me if we're banning flavored vapes and all kinds of things on e-cigarette, and when many of those same companies are in the marijuana business and are absolutely going to try and get in here, that we wouldn't do the same thing for marijuana. So we can look to those examples. We can look to the no smoking law, a Clean Indoor Air Act kind of examples. So there are things that can be done. The fundamental disagreement is that I don't think that revenue that we're talking about is going to even come close, budget aside, is going to even come close to needing to provide for the prevention, treatment. Again, where we're putting our vulnerable healthcare resources, given the current pandemic, the driving issue, and these other things that are going to happen. I absolutely want to reduce police presence when it comes to marijuana. We're on the same page there. But I personally, when I look at Colorado and see an increase in youth, Black and Hispanic youth being arrested in Colorado after legalization because of, it's still illegal for under 21, it's still illegal public use, it's still illegal on, in public transit, although lately in Manhattan, it sort of doesn't seem that way, but it's supposed to be. And those things could be enforced, and we could actually see in many ways an uptake in enforcement among certain populations, like we've seen in Colorado. So I think we have to be very careful in thinking.
If I may interrupt you, I want to allow the other panelists to speak, and I'm well over my time.
Oh, yeah, I didn't notice.
So in terms of safety, if you look what we've done with the hemp CBD extracts bill, there is very strict full panel testing for all pesticides, chemicals, etc. There's very clear labeling instructions. There is a whole seed to sale tracking system in place, third-party inspections to make sure that we're not putting out products, or the cannabis industry is not putting out products that are dangerous or harmful, like the illegal industry could be doing onto the marketplace. And so I think that, that is really the biggest thing and the biggest advantage we have about the legal marketplace is the full transparency and testing and labeling that we can provide.
And the good news is that's already in place in New York with the medical program. There are already very strong regulations around testing standards, advertising, processes already established for reviewing products and reviewing advertisements and even speaking engagements. And a number of those protections are already in place and would just need to be expanded and applied to the adult use market.
Thanks very much.
Thank you. We'll go to the Senate now.
Okay, I think I saw Tom O'Mara's hand up first.
Thank you, Liz. Thank you, all three of you, for your perspectives on this. I'm just wondering, as I sit here in the discussion about marijuana and looking back to Governor Cuomo's change in attitude on this a couple of years ago, where I believe throughout his entire career, according to him, marijuana was a gateway drug.
Yeah.
And then he turned to his health commissioner to look at this costs, benefits of marijuana recreationally. And in the course of, I think it was about 2 months or less, his health commissioner, Howard Zucker, came back with a cost-benefit analysis saying that now the benefits of marijuana outweigh its costs and ill effects on society. I'm wondering if any of you have reviewed Dr. Zucker's analysis and what your thoughts are now on what actually are the benefits of this, other than prospectively a couple $100 million.
Yeah, so we've
I'd
actually
be happy to speak to some of that. First of all, I think, again, the medical cannabis program is here, which is a sign that the state believes that cannabis does have benefit for some consumers. The average medical cannabis patient in New York is a 55-year-old woman and she's sick. That's actually not too far off from what the average cannabis consumer looks like in an adult use market. According to Albert Einstein Montefiore's research in Colorado, roughly 2/3 of all adult use customers are coming in for a health or wellness reason. And the top 3 reasons are insomnia, anxiety, and chronic pain. And so I think that, like a lot of folks over the course of even of the last few decades, as we have seen
my
more
question,
research.
Nagise, my
we've seen
question
more
is not
evidence.
about the medical aspects of it. It's about the recreational aspects of it. I was one of the first Republicans to sign on to the medical marijuana legislation and support its use for
And we
medicinal
appreciate that.
purposes. It's the recreational side of it that concerns me, and how the health commissioner
So-
reviewed this in a matter of 2 months, determining that there were now all of a sudden more benefits of it than there were societal costs of it.
So, Senator, we actually did a review of Mr. Zucker's specific report that you're talking about. We did a line-by-line review, and when I say we, I'm talking major, researchers, NIH researchers, nonpartisan folks that some of them don't have an opinion on legalization, but they were really struck. I got to be honest with you. And again, as somebody who worked in Obama's drug strategy, I have respect for the governor and I have a respect for Mr. Zucker, but we were really taken aback, if I'm to be honest here, at the tone and the things that were emphasized in that report. And I wish I could say it was in a good way. We were taken aback, but it was not in a good way. And there were many questionable claims that looked really straight out of talking points from the industry. And I think the political timing was interesting. I think that we have to look at all of that, but I'm happy to share in the chat with panelists and attendees the rebuttal, which was from about 2 years back right now, that goes through that. So I'll yield the time, but you can see that.
That'd be great. Thank you.
Sure.
Okay, Tom's done. Assembly, anyone else?
No, we do not.
All right, then I'm going to turn to Senator Alexis White. Did I pronounce your last name correctly? I didn't, did I?
Yes, you did. Like is correct.
Oh.
Thank you.
Thank you.
So thank you to all of our panelists. I appreciate your input. And I just, Kevin, I'd like to tell you, you're not the voice of one, you're the voice of many. As I've talked to many communities, I've not yet heard of a community that supports the legalization of recreational marijuana, especially in a time when we're looking at the effects of smokers and what it's having on COVID. I don't think we're looking to legalize something that people are now going to be inhaling, damaging their lungs and making them, another candidate for COVID and overwhelming our hospitals. So this is probably not a good time, especially when we are fighting to get rid of opioids, and this is something we've spent billions of dollars on, and now we're going to try to make them legal, and that's supposed to help us in our fight. As Senator Krueger has mentioned, this is a mind-altering drug, and New York is one of the largest markets already. What on earth makes us think that creating a law is going to actually eliminate the black market and actually create revenue? Does anyone think this is actually going to create revenue, especially when we're looking at other states that have already proven that this is not creating a revenue. There's a short-term influx of revenue, and then the black market takes over again. So what are we looking at? Why are we making this legal, and what revenue can we expect?
I would disagree with you strongly that the black market takes over again. I mean, if you look at the more mature markets like Colorado, like Oregon, most of their sales have actually moved to the legal market, not the black market. So I think that's just an incorrect assumption. And then, yes, smoking anything and cannabis can be a public health issue, same to your point, but the fact still remains that New York is the biggest cannabis market in the country, as Senator Krueger has just mentioned. So to not get this under control, to not have products that are regulated, to not tax them and pay for the public health damage that could already be occurring just does not make any sense. I completely disagree that black market will thrive here. If taxing is done right, if licensing is done right, if we give the right entrepreneurs the access to the market in their own communities, the black market could be gone in a matter of years.
One thing I love about living in New York and being a New Yorker is that, we usually do things better than anyone else, and we know it, and we do. We follow through with that promise. And I think that hubris may get us into a little bit of trouble this time, because every state before this has said these exact things. We will fund these communities. We will get rid of the black market. We will have robust regulation and testing so we know what's in it. And when you look at, for example, again, don't take our word for it. Look at independent reports. I mean, I clearly have a point of view, but look at independent reports like the Oregon Secretary of State report that came out last year, 2019, which found that basically 3% of the entire state legal market was being regulated properly. The vast majority of sales were happening on the gray or black markets. And it wasn't fulfilling the promises that it said. And so, again, look at Ontario, Canada. I mean, we're a state that neighbors, our neighbor to the north. Look at the Auditor General of Ontario, Canada province, which just did a report saying that 80% of their market is still on the black market. And these are, eminently sensible Canadians, and with regulations that frankly don't have the influence of big tobacco and alcohol, like unfortunately many of our US states do. And they are freely saying, sort of quietly saying, but they are saying this is a problem. So I urge you all to do that independent research.
I'm very confused. You're telling us big tobacco and big alcohol is going to come in and take over the entire industry, but the black market's going to be completely flourishing.
Absolutely.
Is true, wouldn't those huge industries want to completely abolish the black market and steal all the money?
All right, folks, this isn't an opportunity for you to debate each other. It's for members to ask questions. And I believe that we have no other members looking to ask questions.
I just need to close with one statement. I'm sorry, Helene.
Sure.
Just to clarify for Senator White, when she referenced marijuana as if it was an opioid, it's not an opioid. There's no research showing that it leads to addiction like opioids. And in fact, the places in the world and this country that have easier access to marijuana have lower levels of opioid abuse and overdoses and death. So you might not like marijuana and you might not want legal marijuana. That's totally your right. But please don't confuse what cannabis is and what opioids are, because they're not.
Well, Senator, please know that I'm not confusing them, but no doubt it is a gateway drug and it will lead to opioids, as facts and research will show you. And it's time and time again everywhere. And if you ever had a loved one who was an addict, you'll know that it's generally a gateway drug to opioids. And since we're spending billions of dollars to fight opioids, I don't think we have the money set aside to then facilitate the rehab centers and the medical costs it's going to cost the state, when we see all of the dangers that Dr. Sabet has been referencing. And I don't think the state is in the position to fund those issues at this time. Do you?
Well, I'm hoping that revenue from legal marijuana will help to fund drug treatment and prevention and education. And again,
no one actually answered my question. I was asking, how much revenue do we actually expect to make from the legalization of recreational marijuana?
Oh, it's projected over a longer period of time. So I can get you the data from my proposal. I won't tonight, but I can get you that. But again, the science has proved that it is not a gateway drug to opioids. And that's
I
been.
think there's
So
many
with that,
scientific
we're gonna
research
move,
that,
we're
that
gonna,
can debate that, yeah.
we'll leave this for future debate and thank our panelists for being here and for helping having this lively debate. And we will move on to panel D.
Thank you all for the opportunity.
Thank you all.
Thank you.
Thank you. Saratoga Harness Horsepersons Association and New York Hotel and Motel Trades Council. Joseph Battaglia is with the Saratoga Harness, and Richard Maranko, president of Hotel Trade Council. So if we can have Joseph go first.
Sure. Thank you. Good afternoon. My name is Joe Battaglia. I'm Secretary Treasurer of the Saratoga Harness Horsepersons Association, representing more than 650 members, including racehorse owners, trainers, drivers, and grooms, the people that create the excitement at the Saratoga Harness Racetrack. There's a section of the proposed budget, Part LL Article 7, that provides at our association's expense a windfall for out-of-state run Rivers Casino. This would simply break the backs of our memberships. It's an unanticipated expense. Instead of Rivers paying statutory per support payments to our association, Rivers would be getting a free ride to the tune of millions of dollars, and we respectfully ask that Part LL be removed from your respective budget bills. The statutory purse payments come from video lottery terminal proceeds, many people may know as the slot machine proceeds. Our VLT share was earned by our participation as a stakeholder in the original Racino legislation. In fact, Saratoga was the location of the state's first Racino. The expansion of the 4 casinos upstate was done with clear expectations that the VLT revenue would still be shared with horsemen's associations as per support payments to protect our industry. These payments would be based on annual revenue levels achieved in 2013 plus inflation. It's the responsibility of the state's racinos and casinos to ensure that the funding of these payments is made. To be clear, this responsibility is not unique to Rivers. Rivers, in fact, shares that responsibility locally to our association with the Saratoga Casino, who is a separate entity from us. What is unique to Rivers, however, though, is that they have failed to forward any payments to the Saratoga Harness Horsepersons for over a year, including the period that was earned before the pandemic hit. So the questions that we have and the concerns we have is, why is Rivers Casino, which is operated by an Illinois-based gaming corporation, being awarded a windfall in the millions of dollars? And why are the hardworking horsemen and horsewomen at Saratoga Harness being assigned the burden of paying for that handout? And why is the state part of a plan to hurt local businesses and damage the already struggling economy of Saratoga? The remedy here would be to remove Part LL from your House budget bills. We must protect the horsemen at Saratoga Harness. They must get their fair share of the VLT revenue. If you strip the millions of dollars of per support, real people with mouths to feed and mortgages and rents to pay will be hurt. It's the price we simply cannot afford to pay. Our percentage of the VLT revenue is not lavish by any means, and every dollar is critical to our members. If you strip the members of these millions, in addition, local small businesses that service our industry, the hay, the grain, the shaving suppliers, the blacksmiths, the veterinarians that attend to our horses, and the breeding farms throughout the state will also be hurt. It's clear that this is a sweetheart deal for Rivers, for only Rivers, and has no place in the state budget. So on behalf of the hundreds of New York State small businesses that comprise our membership, I'd like to thank you for your time and attention today.
Thank you.
Yeah, the hotel. Yes, Rich, please go ahead.
Hi, good evening. My name is Rich Morocco, and I'm the president of the Hotel Trades Council, the union that represents approximately 40,000 hospitality workers in New York. And I'm proud to say that unionized hotel and casino workers in New York have the best hospitality jobs in the world. The highest pay, the best benefits, and most importantly, a contract that allows them to have real dignity at work. For years, that's meant a stable income, access to healthcare, and a better quality of life for our members working in those industries. But as the COVID-19 pandemic hit and then quickly deepened, everything changed. It had a devastating impact on both the lives and the livelihood of our members. Hundreds of our members have died of COVID-19 and several thousand have become ill. The COVID crisis has also ravaged the hospitality industry and as a result, eliminated thousands of our members' jobs. Over the course of a few weeks last spring, the vast majority of our members found themselves without work as the travel and hospitality sectors ground to a halt. And while there may be a light at the end of the tunnel with the advent of vaccines, there's a long way to go before the industries that employ our members fully recover. And I'm here today to talk about some of those workers. While the vast majority of our members who work in hotels are still unemployed, one of the lone bright spots for our union in recent months has been the casino industry. Our members at these casinos work as housekeepers, cooks, cashiers, dealers, guards, and dozens of other classifications. And we've been able to collectively bargain industry-leading pay, high-quality, low-cost healthcare, and employer-funded retirement benefits for these workers. The union's presence and our contracts at these casinos has truly created a path into the middle class for them. There were several scheduled to speak, and I'm not sure whether they'll be able to. But while the hotel industry's core business has been ravaged by the pandemic-related travel restrictions, casinos have been able to recall a relatively high percentage of their pre-pandemic workforce. Unfortunately, the casinos that employ our members are still in deep trouble. For the 3,000 members who work at the upstate casinos, Resorts World, Rivers, and Del Lago, the situation could become very dire very quickly if the legislature and the governor don't act swiftly. Now, while many of the financial trouble these casinos find themselves in predate the pandemic and are the result of a variety of sources, the advent of COVID has certainly exacerbated them. Even before the crisis, these casinos were struggling as a result of several factors, including competing with out-of-state and tribal casinos that pay far less in taxes. We knew that if nothing changed for the better, it was only a matter of time before their financial problems went from bad to catastrophic. And needless to say, the pandemic has made things exponentially worse. Casinos in New York were required to close for 6 months. Since their reopening in September, they've been operating at partial capacity, which has hampered their ability to make a quick financial recovery. If these casinos close, the state will have to figure out a way to make ends meet without an industry that's generated hundreds of millions of dollars for education, and thousands of our members will lose their jobs. Saving casinos upstate is obviously good for the state and is good for workers, but there's one additional factor I'd like you to consider. All of our contracts include a reopener clause, and that clause requires that if the tax rate applicable to any of these casinos is changed, it ensures that the workers, and by extension the local community, stand to benefit directly from any relief the state gives in the form of an adjusted tax rate. And for that reason, I humbly ask that the legislature do everything within its power to help the upstate casinos in whichever way you can, so that they can continue to provide great jobs to New Yorkers. During these horrific times, these jobs have offered a lifeline for thousands of residents across the Capital Region, the Finger Lakes, and the Catskills. Now, we had 4 casino workers who were ready to testify, Enrique Gomez, Alex Zhang, Marianne Ferreira, and Nicole Brown. I'm not sure whether they got kicked off the queue or not, but I would like to bring to your attention that they did wait patiently for several hours because they wanted to emphasize to you how important their jobs are to themselves and to their families, and to entreat you to do anything you can to ensure that they can continue to have those jobs and the middle-class lives that they provide. And I'd be happy to answer any questions.
Sure. Well, I don't believe that they're here. I don't think that they have that there have been separate requests for them to testify, but would appreciate if they could put in writing some remarks and send it to the committee, and we'll make sure that it gets distributed to all of the members of the Ways and Means, Senate Finance committees and the Racing and Waging.
I mean, I know that my colleague Joe Adabo was trying to get onto the hearing to ask questions, and I sent a staff person to help him. It was having a little problem, so hopefully He's going to pop up in a second if people don't mind waiting a second or two.
We can wait. We could shuffle a deck of cards while we're waiting for him to
Sorry.
come.
It's like, it always goes wrong at exactly the wrong time, you know? So,
Because, Senator, I do see that Senator Lou has his hand
perfect.
raised, so
Senator
why don't we
Lou.
go to him? Because we do not have any assembly members.
Oh, thank you. Senator Lou, I see your hand and we would love for you to ask a question or two. Hi.
Thank you, Madam Chair. This is great. I feel like I have an unlimited amount of time until the next.
No, you have 3 minutes, but enjoy.
Okay, well, it's great to see this panel. Thank you for patiently waiting for so long, but your testimony is important. And to President Morocco, are there any specific proposals or pieces of legislation or tax items that we could help legislate so that we can keep these jobs in New York?
Well, primarily a reduction in the tax rate applicable to slots. You know, there are a variety of different tax rates applicable to each of these casinos that vary fairly widely, but are significantly higher than their competitors, either out of state or with regard to tribal casinos. And I think reducing those rates to something far more reasonable would be key in ensuring the survival of these casinos and therefore the preservation of these jobs for, you know, close to 3,000 workers at these 3 casinos alone.
So these are rates that are statutory rates?
They are, and as I understand, these casinos come back on basically an annual basis to try to renegotiate them. And they are not consistent among the various casinos, ranging from I think 37 to 45% currently.
Got it. Thank you very much. And Mr. Battaglia, are you aligned? I mean, is your organization of the same mindset as Mr. Feraldo's organization, the Horsemen's Alliance?
Yes. Mr. Feraldo's association is comprised of different tracks throughout the state. So our concern is their concern.
Terrific. Thank you so much. Madam Chair, I just want to demonstrate to you that I do not always hog time. Thank you.
Oh, I'm sorry. I did not mean to offend you. Thank you very much for jumping in. I believe that Senator Addabbo is now with us. Senator Addabbo?
I am not seeing the senator in our list here.
Oh, well, then I was misinformed.
I have more questions, Madam Chair.
No.
No.
We want to have some dinner tonight.
It's true. You know what? Senator Addabbo says hello to you both, I think. And I'm sorry that I can't bring him on the screen now. So I'm sure he can follow up with you both afterwards. Thank you. Thank you, Helene.
Okay, thank you. So now we're going to go to panel E, Alliance for Clean Energy New York, Ann Reynolds, New York State Assessors Association, Scott Shedler, and Upstate New York Towns Association, Carolyn Warren Price. If we can go in that order. So Ann Reynolds first.
Thank you. Thanks so much for the opportunity to speak. I'm with the Alliance for Clean Energy New York. Can folks hear me? Yeah, yes. Good. So it's ACE New York. We are a membership-based organization, and our members are clean energy companies as well as environmental organizations. And my testimony today is focusing on Part X of the revenue bill of the executive budget, which addresses the issue of property taxes for wind and solar. So my written testimony talks a lot about the background and why we need these projects, but briefly, transitioning to renewable sources of electricity is the best strategy and the most important strategy in the fight against climate change, a fight that this legislature has endorsed by virtue of passing the CLCPA, the Climate Leadership Act, in 2019. So we strongly support Part X of the revenue bill. It would amend the real property tax law and the general municipal law to direct the New York State Tax and Finance Department to publish a standard method for assessing wind and solar projects. And it also makes it clear that renewable energy is among the types of economic development that industrial development agencies are allowed to support. So we care about the taxation of renewables because the process to negotiate a property tax agreement with 3 jurisdictions, the city, village, or town, the school district, and the county, is currently taking up to 2 years and more. And by providing a standard methodology, the state of New York could help with that. These are unique land uses for which there's really currently no agreement on the appropriate tax approach. New York's towns, counties, and IDAs will have a consistent foundation on which to make decisions about taxation if this legislation was to pass. So it's important to note that nearly all wind and solar projects in New York are taxed via payments in lieu of taxes, pilot agreements. And this bill would maintain the flexibility for the communities to continue to use pilot agreements if they would like. In some cases, though, community members object to a pilot being used in the belief that it's an unfair subsidy for renewable energy projects. And in fact, we view it as the vehicle by which these projects pay their taxes, not necessarily a tax break. But in any case, when this happens, the local government then looks around to determine what full taxation would be. But there's no state guidance and very little precedence on which to base this decision. As I said, wind and solar are unique land uses, and you can't simply compare properties like you would for a commercial building or a home. And the amount of revenue that a wind or solar project generates is absolutely related to its size, but it can depend also on the power prices in that area, how windy or sunny the area is, and other factors. So we really think it would be helpful if the state of New York would publish a standard assessment methodology, which, by the way, exists for oil and gas exploration, and while still allowing the municipalities to choose to do a pilot if they want to. So we support Part X. We think it strikes the right balance, and we respectfully request that both houses of the legislature include it in their one-house budget bills and support it in the final budget. And I'm happy to answer questions.
New York State Assessors Association.
Yes, good evening. First, I'd like to thank you, the committee, for allowing me to speak this evening. My name is Scott Shedler. I'm the immediate past president of the New York State Assessors Association and an assessor in the town of Ramapo, and I'm currently the legislative liaison. I want to thank this legislature and their staff for the dedication over the past year, and thank you for supporting a majority of our recommendations on last year's budget. First, what I'll speak about is Revenue Bill X, solar. The New York State Assessors Association has reviewed the bill pertaining to the valuation of solar and wind, and we're very concerned about this proposed legislation. First of all, this takes the taxation, the valuation out of the hands of the local assessor. Currently, as amended, this legislation was amended recently, and it takes the income approach out of the mechanism for valuation, and it allows for the use of a discounted cash flow. This discounted cash flow will be using a discount rate, and all these rates and methodologies will be derived from the Department of Tax and Finance. So there's a concern that since there is no methodology actually that they have in place, or one that's proposed at this point, it wouldn't make, we don't recommend adopting legislation without knowing the outcome of that model. We've asked industry analysts, one renowned appraiser on solar and renewable energy, to look at this discounted cash flow approaches, and depending on the varying discount rate, it could have a devastating effect on the overall taxes that a municipality has. This also raises constitutional issues on taking the valuation away from the local entity, the home rule issue. We're very concerned about losing possibly 50% of assessment on a project. We're totally in favor of renewable energy and the need to expand it. but we think by mandating an approach that, first of all, we don't even know what the approach is going to be, it could be devastating for municipalities across the state, especially now when many of these municipalities are stretched with their budgets dealing with COVID-related issues. So we're asking that you remove item X from the budget. These solar farms and winds generate electricity that goes into the grid. If the state wants to legislate incentives at the state level, not at the local level, that might be an alternative, because it feeds electricity into the grid that serves many different municipalities. So really, maybe we should look at it as an overall state issue. Lastly are the STAR changes. We recommend a majority of the STAR changes that are proposed. We do feel that because of the assessor's calendar, these should be phased in over a multi-year period. Thank you.
Thank you. And now Upstate New York Towns Association, Ms. Price.
Here. Okay, thank you very much. And I'd especially like to thank Chair Weinstein and Chair Kruger and distinguished members of the panel for giving us this opportunity. I'll speak about two taxes. The first is the right-of-way tax, also known as the fiber optic tax, where the state is taxing companies with fiber lines in the state right-of-way. And this is really working against what we're trying to do with broadband. We need to expand broadband in upstate New York. And we've really seen it during COVID. I'll give you one example. A young mother at home trying to do her job and two children doing schoolwork. This is very typical. And they only have satellite. And the mother's out there taking the snow off the satellite. They should have fiber. So we shouldn't have a tax that's discouraging the installation of fiber. And I commend both the Senate and the Assembly for having bills to repeal it. It's in committee, and we encourage you to get those bills out of committee and pass them so we can have more broadband in upstate New York. The other is the sales tax, and you're probably aware that the state is taking local revenues through taking sales tax money and using it to cover the cost of AIM and now also the Distressed Hospital Fund. And this has been a large loss for counties. And I know the Counties Association has testified on this also. And we're afraid this is becoming a trend, and it really needs to stop. We need all of the local sales tax going back to the counties and towns. And you might say, well, what are our options as a state when we have a gap to fill? Well, in the towns that I represent, when we have a gap, we first of all look at other revenues. Is there another way we can get revenue sources? And the other is we look at our expenditures. And maybe we can't spend quite as much money and we have to cut back. But this is really becoming a problem for counties and towns to have the state withhold the sales tax that really was, say, a 4% local revenue. And we would like that to stop. And I'd be happy to take any questions that you have.
We have, I'm not sure for who, but we have Assemblyman Ed Ra to ask a question of one of the panelists.
Thank you. So my question is about an issue that there's obviously the first two panelists don't necessarily agree on, but with regard to this provision regarding the wind and solar projects and assessment on it. Obviously last year with the siting amendments, there were concerns from the local level regarding the ability for there to be adequate local input. Obviously there are people who believe there's still adequate local input, but there's also a lot of people that do not believe that there are. And there's I think a similar concern here. And I'm just wondering, Mr. Shedler spoke about the lack of detail with regard to this proposal. And if you could speak a little bit more about that, and from the other side of it, if Ms. Reynolds has any thoughts about if there is kind of some common ground that could be found to get to a place that helps achieve some balance there.
Yeah, in fact, the association has been working for over a year now with the industry association. We've recently been working with the Department of Tax. We've had dialogue back and forth. In fact, we really recommend that we set up a separate task force to study the different approaches. We were kind of shocked at the last minute that there was an amendment that took out the income approach and just left the discounted cash flow approach. So in fact, tomorrow we have a call with the industry on valuation approaches and the discounted cash flow approach. So we are open to discussion. The commissioner has been very transparent in having his agency work with us. We had conversations as recent as yesterday. So and they're open to dialogue. So I think you pointed out a really good thing is that we should work together, all the groups and try to hash out different types of methodology. And I think that would be very productive.
Yep, I will add to that. So I'm again with the Alliance for Clean Energy, and along with the New York Solar Energy Industries Association, we had conversations with the Assessors Association, the Association of Towns, and the counties, basically from the end of last year's legislative session through this summer. From the renewable energy developers' point of view, what they would love, like the ideal situation, would be a standard pilot payment, this much money per megawatt in by region. But in our conversations, it became clear that it seemed like the municipal association had a preference of having a standard methodology be published by the state, but they still have the ability to choose whether they want to go that route or negotiate a pilot. And this bill would allow them to do that. I think what Scott is pointing out about having a task force to hash out the details of the methodology is a good idea, and it can happen when this legislation passes. It simply directs Tax and Finance to publish the methodology. There's still a lot of details to work out about what the model would be and what the discount rates would be and how it would vary by technology and how it would vary by location in the state. And so all of that isn't laid out in Part X, but having a direction to the state to publish a standard methodology that could serve as the foundation for negotiations of pilots, I think would push this towards less lengthy debates and more standard tax treatment across the state.
Thank you.
Thank you. Thank you. If we can go to Sandy Gala, our real property tax chair.
And I have to apologize. I got myself off when Scott was talking. I'm sorry, Scott. I pushed the wrong button and there I was. Anyway, so a question for Scott, a couple of questions. It seems like with this issue of the renewable energy in the budget, we really probably, it seems to change, and it changed with a 30-day amendment. It would seem like we could take that out of the budget, resolve the issue, and then pass a legislation at another time. Is that something that?
Yeah, that's exactly. I mean, you really can't pass you're totally right, Chair Gale. You can't pass legislation without knowing what you're going to get. Let's work together and work something out and maybe get legislation later. That's a great idea.
Okay. Mobile homes, do you have any position on the mobile home legislation, sending the check directly to the renter of mobile homes?
Yes, in fact, we're supporting the amendment and that aspect of the budget, as well as we really think that cooperatives should be included in that, as well as mobile homes.
Is that doable? I'm just thinking about New York City with all the cooperatives. Is that a doable kind of thing?
That would be a Department of Tax and Finance issue. We do supply them with all the data. I don't know what they supply them with in New York City.
Okay. And another question for you is about the value of the state real property tax board. Do you use them? Do you find constituents do? Is there any value to them?
Well, I think what you had pointed out earlier is it really would make sense, first of all, to legislate or direct them to have virtual meetings. And it definitely is at a disadvantage to only have 3 members on the board.
Right.
It's problematic. When I started my career at the town, we actually testified before the board. And if we had 3 members at that time, it would have caused a conflict. So either put 5 members on the board and allow them to do Zoom and move the agenda along, or if you're not going to do that, then I guess you'd have to go with what the governor is recommending in his budget.
And I do have your statement, but I didn't ask you the question about Enhanced STAR, the changes, and to put everybody in the credit program. Your response.
So the association is very concerned about calendars. So if we're going to do anything, we have to not do it this year. We would have to phase it in. To make a change just is very disruptive to the public, especially the seniors. So it's apparent that they're going to move to this direction. It should be phased in over 2 years. And that's what we supported on all these amendments, is you really can't adopt something in the year that we're working with. So you adopt the budget in April, we come out with a roll in May. It's just very chaotic for the public, especially now during the issues that we're dealing with.
Thank you.
Thank you.
Senator Krueger.
Thank you. I just want to say to Carolyn Price that I agree with you completely. I think it's one of the most short-sighted things the legislature's gone along with when the governor proposed reducing AIM, but then replacing it with your own sales tax and then continuing it on an extended period of time. It's such a tiny amount of money for the state with such enormous impact on endless local governments. And so having sat through all the hearings with your colleagues from other organizations and read their testimonies and met with them, I just wanted to say, we try to do our best every year. We don't always get there, but I think this is going to go down in history as one of the very bad actions we took ever trying to reduce AIM in the first place, and then pretending we weren't taking your money when clearly we were. So thank you for your testimony.
Yes, and if I could just say, I really appreciate that. And it's, like you said, it's small dollars for the state, but it's big dollars in the town I live in. Last year, we lost $29,000 from that. And right now we're looking for $36,000 to go toward a large piece of equipment in our highway. If we'd had that $29,000 last year, we wouldn't be looking where we are right now. So that just gives you an example and you understand it completely. Thank you very much.
Thank you. Thank you, Aline.
Yes, thank you. There are no further questions. I want to thank the members of this panel for being with us today. And we're going to move on to panel F, which is Hunger Free America, Joel Berg, DSA Debt and Finance Working Group, Boris Santos, Village Independent Democrats, David Siffert, Youth Alliance for Housing, Asher Avery, and we have from panel A has returned to us from Tax Justice Network from Yale University, James Henry. So if we can go in that order, that would be appreciated.
Good evening. I'm Joel Berg. I'm CEO of Hunger Free America. Thank all of you for your public service. We are a national organization, but we're based in New York City and we work statewide. I'll cut to the chase. Hunger was a huge problem before the pandemic. We sometimes pretend that all of a sudden it came out of nowhere. But now in the pandemic, it's a massive crisis. 1 in 4 state residents, equaling 4.5 million New Yorkers, face food hardship. In the richest state in the history of the world, 1 in 4 of our fellow neighbors don't have enough money to afford food. And frankly, it's just obscene that this has happened at the same time we've had an explosion of billionaire wealth aided by massive tax cuts and the lowest federal marginal tax rate in really 100 years. I'll remind everyone that the top marginal tax rate was 91% federally when Dwight D. Eisenhower, a good military Republican, was president. The top way to fight hunger in New York and every other state is to better leverage federal nutrition assistance programs. Every dollar spent by the state on outreach for the SNAP program, what used to be called the food stamps program, generates at least $20 worth of federal funding in the state. This year, SNAP benefits will be about $6 billion in the state, $6 billion in the state. And even increasing that marginally through more outreach would do far more than a zillion food drives and even the important Nourish New York program or the Hunger, Nutrition, and Assistance program. Because funding is so little at the state level, we've actually been cut off, us and advocates and funders and program providers around the state, cut off from funding to do outreach for the Women's, Infants, and Children program with pregnant women and children under 5. We've called for $650 million more in state funding, both for outreach and for direct food, but that equals 1/923rd of the net worth of just a few dozen New York billionaires. Let me repeat that. We could massively reduce hunger in New York City by just having a handful of a few dozen people paying almost 1/1000th of their net worth. And I'll just close is none of us made it on our own. Every billionaire and millionaire in New York has a workforce that went to public schools. Every billionaire and millionaire in New York has their goods and services provided over public roads, through public airports, through public ports. Every billionaire and millionaire in New York benefits from subsidized or free drinking water. The idea that we're going to create this myth that they made it on their own and somehow we're being mean to them, or that this is about revenge, when this is about patriotism. This is about what's doing right for our neighbors. This is about my putting on notice all the people who claim to be faith-based advocates, that let's follow and practice what we preach and make sure the wealthy pay their fair share so we don't have 1.25 New Yorkers going hungry. Thank you.
All right, so Boris Santos.
Can everyone hear me? Great. I'd like to begin by pointing out the fact that nobody from the Division of Budget was present today or throughout this budget process to give testimony, from what I have. It's important to highlight this because we cannot realize a progressive taxation code at the state level. We cannot live up to a robust democratic state if we don't have critical executive agencies not engaging in our process of checks and balances. This is even more important given the light of information we have with the nursing home situation. I'll leave that at that. But the public's mistrust of government will continue even in a post-Trump era precisely because of actions such as DOBs. Mama always told me the #1 rule in life is to show up, and that is why I'm here. And I am disappointed that the DOB is not. With that said, my name is Boris Santos, and I am a member of the Democratic Socialists of America Debt and Finance Working Group. The Debt and Finance Working Group comprises of financial and economic experts, an asset manager, a tax lawyer, an employee of one of market indices, myself, a former state staffer, and others worked alongside David as well, who's coming after me, worked alongside to help create the Invest in Our New York Act. And I'm here today to demand that your one-house budget proposals, both of them, contain progressive revenue options that raises taxes on high-income earners, on wealth, and on corporations like the Invest in Our New York Act, in order to help fund more than that which we will receive in our state coffers from President Biden's American Rescue Plan. The needs of our state are great, and were great since before this pandemic. And I'll challenge anyone to say that even throughout federal funding, every one of their constituents will be served. Everyone will be contained in their place of commercial business or their residence. The Invest in Our New York Act was created knowing that since our current governor has taken office, and especially during Trump's reign, our state has not been progressively bold in the area of taxation. This becomes more frustrating knowing that we are one of the states that leads in income and wealth inequality. The tax burden imposed by the state on the top 5% in our state has decreased instead of increased in the last decade, and yet our state gross domestic product has increased from $1.4 trillion to roughly $1.8 trillion in that same decade. In the area of PIT, personal income taxes, increases have been proposed starting at the top 5% threshold of filers, that's $300,000 for single filers, $450K for joint filers and head of households. Starting at this threshold is critical, especially relative to the governor's extremely flawed PIT proposal, which begins increases at the 0.515% level for tax filers, 0.15%. It makes no sense to raise flags publicly, as the governor has done, about how a small few taxpayers bear more than half of the personal income tax load in our state, and then propose a temporary surcharge that's tied to a smaller few. The Invest in Our New York proposal, PIT, can be characterized as displaying the following attributes. Increases starting at the top 5%, as mentioned, more progressivity in the form of increases to newly constructed brackets. If you cross compare the combined New York City and New York State PIT rate with both Hawaii and California, they tax more, beginning at the 200,000 to 1 million range. Zoran Mamdani, assembly member, pointed that out. And it should be permanent. I, as well as others, fear that the state is labeling increases to specific areas of the budget due to federal funding, but it's not accounting for any potential hole following the injection of federal dollars to those areas in latter years. I will leave it at that. My testimony is meant to serve as a resource for all legislators and includes charts as well. The Empire Center is not the only one. I do think we need to, just to finish up, we need a cap on unearned income tax surcharge, corporate taxes need to be increased, etc. Thank you.
Thank you. We need to move on. David, yes, why don't you go forward now?
Thank you, Chair Weinstein, Chair Kruger, members of the Finance and Ways and Means Committee. My name is David Siffert. I'm chair of the Legislative Affairs Committee of the Village Independent Democrats. I used to work as a tax attorney at Gibson, Dunn & Crutcher. I currently work as the Director of Research and Projects at the Center on Civil Justice at NYU School of Law, though I'm not here in that capacity. I'm here for the Invest in Our New York Act. The backbone of our state's revenue is the personal income tax. There's a good reason for that. It's efficient and it's easy to administer. There's also substantial evidence that when you increase the personal income tax, you increase revenue. Some people do move out of state to avoid the tax, but the amount of money you lose from them is vastly exceeded by the more money you receive from folks who remain. And I've cited to multiple studies backing that up in my written testimony. Moreover, right now, wealthy people understand the extreme needs in New York in response to this crisis, and they're willing to pay higher taxes to provide for them. There are many wealthy New Yorkers, but we cannot hold our state hostage to the cruel few who would move in order to avoid helping their suffering neighbors. Beyond the PIT, the other tax I want to highlight is the inherited wealth tax, or heirs tax. This is a tax that often gets more pushback than other taxes, but in my opinion, that pushback is substantially more irrational. One concern we often hear is double taxation. First, our system is built on double taxation. We tax corporate profits, and then we tax that money again as dividends. We tax personal income, and then we tax that money again when you spend it on goods via the sales tax. The reason for this is because the amount of times money is taxed is completely irrelevant. Two 10% taxes are economically and mathematically indistinguishable from one 21% tax. One can object that something is taxed at too high of a rate, but one cannot logically object that something is taxed too many times. More importantly, much of wealthy estates is actually never taxed. Our capital gain system only taxes gains upon sale or disposition. When someone dies and passes along an asset, it gets what's called a stepped up basis. This means that any unrealized capital gains are wiped out upon death and never paid. For wealthy people, this is often the bulk of an estate. So an estate tax is truly the first and only tax on much of the wealthiest estates. The other argument we hear against estate tax is that, again, that it will encourage people to move. But like with the PIT, there's hard evidence that indicates that when you increase estate taxes, you increase tax revenue. This is because of a number of different reasons, one of them which is that it's hard to avoid the estate tax, so you don't know when you're going to die. Another reason is the people that are likely to move are likely to be elderly and retired, and so when they do move, you lose substantially less income for your income taxes. And then the last thing to be said here is that the heirs tax that we've written is specifically targeted to avoid this kind of avoidance. The bill creates 3 new taxes: an inheritance tax, a gift-or tax, and a giftee tax. There are rebates to prevent double payments, but combined, they create a comprehensive system such that the estate tax cannot be dodged simply by moving away or giving away your money during your life. Overall, the inherited wealth tax is likely to be the most progressive of the proposed taxes and the one with the fewest risks of lost revenue due to tax avoidance. So I strongly encourage you to incorporate it into the budget. Thank you.
Thank you. Asher Avery, next.
Hi, my name is Asha Avery, and I am with Youth Alliance for Housing, which is an organization that was founded around a year ago, right before the pandemic, as a coalition kind of different New York City public school students or former New York City public school students who were working with different equity groups within the city and kind of wanted to highlight housing as a focus. Most of what we've been doing over the last year has been a little bit scattered because of the nature of the pandemic and not being able to necessarily meet and come to big agreements. So most of what we've been doing has been directly looking at people, specifically New York City public school students who are needing help with housing or need help with food or transportation or different kinds of just things that a lot of people were getting before through their schools and are now, because of the pandemic, unable to access them. A few months ago, we started working with the Invest in Our New York Act and joined the steering committee. And I'm testifying today really to kind of highlight these kinds of tax increases will have direct and profound effects, not just broadly in terms of revenue for the state, but also in the people's lives of the most vulnerable people in our state and the people who our state is most supposedly focused towards helping. So in my written testimony, most of what I shared was the story of one of our other co-founders who became homeless in her junior year of high school. And although not during the pandemic, she does talk about how the pandemic kind of created like a worsening situation, not just for her, but mostly for the people around her. And about how, like, although she was homeless, obviously, she was still going to school. Her classmates didn't necessarily know that she was homeless. The idea of what like homelessness looks like and how you, if you're still staying somewhere, are you still homeless? All of those things, kind of the mental effect that that had on her. And also how just like her family was so unable to get resources through the state because of all of the budget cuts that have been happening over the last few years. And also just the lack of money that the state has to be able to provide resources for people who are really vulnerable and really need help. People who are attending public schools, even the public schools that are the best in the city or the best in the state, some of the best in the country. 10% of our students in all of public schools in New York City are homeless, and those students need to go to school and show up in the same way that we expect all of our other students to show up. And when they're not able to have support, or there's no way for the government to come with their shelter system, they can't go to shelters because they're seen as unsafe. They can't get necessarily help through food stamps or through other things because qualifications are very difficult to meet. And all of this really just leads back to the fact that the state has all this money that we could be generating in tax revenue through a lot of the acts or bills that are in the Invest in Our New York Act and many other things. And it's more that we can't say that these people are less important than a few extra $1,000 or $100 or whatever dollars on top from other, from wealthier individuals.
Thank you. And we go to Mr. Henry.
Good evening, everyone. I'm very impressed with your tenacity here, and I'm going to talk a little bit about the stock transfer tax rebate repeal. We put together a coalition in the last 6 months of unions, progressive groups like NYPIRG, quite a few economists, more than 100. I find most economists love this idea of a stock transfer tax rebate. The business is already on the books, folks. It's been on the books since 1905. We can tinker with its precise methodology, but the basic reasons to support this idea is that, first of all, it's not a theory. It just plain works. It raises a heck of a lot of revenue at a tax rate on investors that is 1/80th of the 1/8% that New Yorkers already pay online and in retail stores every day. It is simple to collect and enforce. Contrary to myth, it doesn't depend on where the servers or the clouds are located any more than taxing Amazon does. Its own history clearly demonstrates the revenue-raising success. 1905, a Republican governor, protege of Teddy Roosevelt, introduced this tax, and then Wall Street was aghast. The New York Times editorialized about it, said, you know, everybody will leave and go to New Jersey, it won't raise any money. 3 months later, they had to retract that editorial because Governor Higgins' stock transfer tax actually worked and it balanced the budget. That was the reason it was kept in place for the next 77 years until a Democratic governor, Carey, under pressure from Wall Street during the late 70s, decided to repeal it. By 1982, it had been repealed. If we kept it in place, the rebate still has actually been on the books throughout this period. The Department of Finance makes estimates every year. The total is $345 billion that we have rebated to Wall Street. 80% of shares on Wall Street are owned by the top 10%. We could have done many things with all that money. The tax collected successfully nearly $100 billion during the 77 years that it was in place. It's also a tax on the kind of speculation that Janet Yellen just warned about yesterday. A lot of trading on Wall Street is completely non-productive. Something like 80% is high-frequency trading involved with 10 minutes in and out. The players involved in that are making a killing, front-running, making the market less efficient. Any pension fund should be concerned about being a long-term investor. But pension funds, in some cases, have been captured by Wall Street interests. Last year, the top 3 pension funds in New York paid a grand total of $1 billion of fees to external managers. This tax would cost them maybe $50 million a year, while it's bringing in upwards of $15 to $20 billion a year in revenue. All of the other proposals that you've considered here today, marijuana, taxing sports gambling, a bunch of other things, even the millionaire's tax, which I support, are going to raise a fraction of the amount of money that simply stopping the rebate would raise instantaneously. And you're not alone in this. This is something that you have to do now, because we now have a Biden administration. Jared Bernstein, a key advisor to President Biden, supports a national financial transactions tax. But all the revenue from that tax would go into the federal treasury. We're talking about right now, the average trade on the NASDAQ exchange last year was $8,800. The tax as written today would be 1 nickel on every $100. That's $8.80 for $8,400 trade, 0.1%.
Thank you. We do have a number of questions. And first, on the Assembly side, Assemblyman Mamdani for 3 minutes.
Thank you so much, Chair, and thank you for the stamina of running this entire show. I know it's a long, long day. I wanted to thank all of the panelists for speaking, and I wanted to focus on Mr. Santos. So first of all, thank you very much for your testimony. I wanted to thank you, the Debt and Finance Working Group that has put in so many hours, weeks, months of time to create a vision for our state that is one that is truly just. And I wanted to commend you for your testimony. And it seemed like you had a little bit more to say, and I would be very interested in hearing, with my 2 minutes and 23 seconds that are left, to see if you would be able to illuminate a little bit more of the points that you were making and where you think we should take our state with regards to our fiscal policy.
Yeah, I think beyond just the personal income tax proposal that I mentioned and the areas, permanence, progressivity, further progressivity, and also increasing starting at the top 5%, we need a capital gains or unearned income tax. I think it's simple. We as a state could be leading in taxing unearned income more than earned income through an additional surtax. This is imperative knowing that many give long-term capital gains tax breaks, especially at the federal level. I think ultimately it would be best to decouple any additional capital gains surtax from the federal rates. There's a little deviation there, but we know that in proportion to most of the income derived from the top 5%, most of that comes from capital gains or unearned income, right? And especially after the $1 million income threshold, that was pointed out in Fiscal Policy Institute's current report. With corporate taxes, I think it's clear we have ample room to increase the tax burden on the profits of corporations, given Trump's giveaways, but also we have decreased taxes in this area in the last decade with Cuomo's administration, right? In the 2015 fiscal year budget. We're 5.5 percentage points behind the state of Iowa in corporate taxes. So there's ample room there. On the FTT, I think it's just going to come down on to a matter of political will.
I'm sorry,
we
did you
yeah.
say the FTT or the
Yeah, the financial transaction tax, and I'll mention the difference between the stock transfer tax too. But I think the FTT is going to come down to a matter of political will. We need cooperation with DTF and DOB to best administer this tax, knowing that the industry will not cooperate and they oppose any form of an FTT. Just like someone mentioned, they oppose any form of any progressive revenue tax increases. Boy, to be the party of no today. But nonetheless, the FTT is also superior than the STT because the STT is bottomed on a faulty administrative stamp model, an antiquated system of or antiquated vision of how the market once worked on the floor trading versus what the FTT tackles. It tackles it all, and it comprehensively taxes all financial instruments, not just equity securities, also debt securities and also derivatives.
Thank you so much, Mr. Santos. My time is up. I will yield back to the chair.
Thank you. Senate, do you have?
I saw Julia Salazar with her hand up before, but now we may have lost her.
Okay.
I don't hear her typing up, so I
Trying
guess.
to get her video and audio, but oh, here we go.
Oh,
there
you
she
are.
is.
Hi, Julia.
Hi, sorry, although you actually can remove me from Stack.
Oh,
I appreciate it.
okay. Okay, never mind. So no, it's the assembly then again, Helene.
Okay, we do not have anyone else, so I want to thank panels for sticking with us for today, and we're going to move on to our final, actually, it's not really a panel, it's a final individual.
Could I just say one thing?
Okay.
Yeah, thank you. The point about the national effort is that if New York State doesn't act on the two bills that have actually got 55 sponsors to repeal the stock transfer tax rebate, then Washington's going to take all the money. So it's the EU is moving on this. Washington is moving on it. It's up to you to move before you lose the opportunity.
Yep, we did hear that point before. Thank you.
Thank you.
Okay, so thank you all for being here, and now we're going to ask John Krebs from Element Fleet Management to have 3 minutes to present his issues to the committee.
Great, thank you. Good evening. My name is John Krebs, and I'm the Director of Sales Tax for Element Management. And Element is a commercial leasing company that provides leases and related services to a lot of the US and New York to a wide range of customers, including not-for-profits, government entities, as well as other local businesses and corporations. We're actually the largest fleet management company in North America, and currently in New York, we have over 1,000 vehicles on road and being used by your local businesses. And commercial auto leases are very unique, and we actually incentivize the customer to keep the vehicle in good condition and keep it well maintained. So when the customer turns in the lease, if the vehicle is actually sold for a price that's less than the expected value, we will charge that customer extra rent, so additional rent. And conversely, if the vehicle is actually for a higher than expected value amount and they've taken good care of the vehicle, then we will give them a refund of rent. Currently, New York tax law is silent on the treatment of these rent adjustments, but the Department of Taxation and Finance has taken the position that the additional rent is subject to sales tax, but a refund of rent should not in a refund of related tax or a credit of related tax. And New York is the only state that does negative and positive rent adjustments differently. So the lack of clarity in law and the disparity in treatment by caused a lot of audit time-consuming audit and costly audit issues, as well as complexity in trying to be in compliance with sales tax law, just based on how rent is taxed. So to remedy this situation, Element supports allowing that fleet leasing companies actually pay sales tax upfront on the purchase price of vehicles, much like citizens and other businesses to do. And on our purchases for lease, as reflected in Senate Bill 3926 and Assembly Bill 5401, and respectfully request that this language be included in the governor's budget. Allowing fleet leasing companies to pay sales tax upfront would actually, on the purchase of vehicles, would actually accelerate revenues for New York and increase the tax base. And based on our calculations and projections, New York would actually have a positive fiscal impact of at least $17 million if this was enacted in the first 4 years. And again, the purpose of the legislation is to ensure fleet management companies can simplify and streamline their sales tax compliance, provide clarity in law, avoid timely and costly audits, as well as provide a positive fiscal impact to the state. So,
thank you. Thank you for being here. I do not, I do not believe we have any questions, but we will certainly look at the issue that you've raised. Thank you. I want to thank my colleagues, my co-chair Liz Kruger, for being with us here today. Mr. Temporary co-chair of the hearing, who had very limited role, Ms. Kevin Gale. Thank you for pitch hitting for me while I had to go to take care of some other budget issues.
I believe
so this is
Senator Liu has his hand raised. Sorry.
Okay, he has. Senator Liu needs the last word. So Senator Liu, why don't you speak
I don't
before...
need the last.
No, I'm gonna still have the last word. So why don't
I don't need the last word. I just wanted to thank you and Chair Kruger. You sure know how to throw a party. Can't wait for the next one.
Okay. Okay. Thank you, Senator Liu. So this does conclude the joint hearing on joint Ways and Means Senate Finance Committee on taxes. The joint committees will reconvene Thursday morning at 9:30 for the last of our joint budget hearings regarding the health portion of the budget. We look forward to seeing you all there.
Yes, indeed. Thank you. Get home safe, everyone.